At TSMC in terms of sales there, and generally on the earnings story, a miss. Some challenges there in terms of claims around storm season. Germany, we know, and flooding there was a factor. Some of the stocks to be focused on. Anna.
Yeah, we've had a lot of earnings from the insurance sector this week, so we'll see how those Generali numbers go down with the market. So European equity markets just getting started then for this Friday session. Flat on the FTSE right out of the gates. We are expecting to see a little bit of that upside then. Perhaps some of the tech names could move a little higher on the back of, as I say, that read across from the United States, but also some of the TSMC strength we saw. We've got the Stock 600 up by 0.2%. The IBEX is pretty strong. First thing this morning, up by 0.4%. So a little bit of strength coming through. How long that lasts is, of course, a different question. Will we see that flat Friday? That's what the US futures picture is suggesting. The DAX just opening on the back foot, and the CAC 40 up by 0.2%. These markets look a lot calmer than they did in the earlier part of this week. A lot less volatility, for better or for worse, Tom. But this is the picture then for European stocks right now, up by 0.4%. As many of the data points of the week are behind us, and we look ahead to some really important data coming up next week.
Yeah, inflation data out of the UK, inflation data out of the US as well later next week, along with retail sales. The jobless claims number, of course, coming in lower, the lowest print we've had in about a year, so that gave and led to that optimism we saw stateside yesterday. But I think you can stick with the Anna branding around Flat Friday for now. Across the benchmark then, just gains across the European Stock 600 of around 0.3%. ASML then, one of the tech names in focus given the optimism we've seen from TSMC, the provider, of course, ASML, of these lithography machines to that contract manufacturer. Gains of just 1.3% so far in the session. Generali, another stock that was in focus for us, taking a bit of a hit across your sectors. Going to pull that up for you right now. Basic resources at the top of the list, gaining 1.4%. Travel and leisure also posting gains of a little over 1%. Tech is in the mix near the top of the list, up 0.6%. On the downside, food and beverage taking a bit of a hit, just down 0.2%. You've got about 8 or 9 sectors in the red right now. In terms of your individual movers, some names, of course, in focus for us today. Look, we've been talking about Hargreaves Lansdown, a takeover there, so we'll look at that stock, currently gaining 2.4%. That premium coming through in terms of the bid, the takeover offer, and we'll see, of course, if that deal gets cemented. But so far, investors are rewarding that news, and are generally down now 2% on the back of a miss around earnings. And SML, as I mentioned, in the tech space, up 1%. You're seeing gains as well, just 0.5% for Infineon over in Germany.
Yeah, really interesting that basic resources lead us higher. The focus on base metals has been negative of late. Weeks of losses in some of those underlying resource prices, and that has been weighing on the sector. Travel and leisure getting another day of gains then. Yesterday it was the leisure, and it certainly is the leisure again today, rather than the travel that leads us. It's all that betting on all of that sport that apparently lifts that sector. Joining us now to talk about where we are on these markets after that week that has been, Luke Barrs, Global Head of Fundamental Equity Client Portfolio Management at Goldman Sachs Asset Management. Luke, really nice to speak to you. Thank you for coming in. We spoke last hour to Aaron Captain, UBS Investment Banking Chief Economist, and he was saying that this week's just been one big head fake when it came to the data and what we've learned about the US economy. Have you learned anything useful about the strengths and the cracks in the US economy this week?
Well, look, I think the starting point here is there's been a lot of volatility. It's been data-driven, but actually the underlying strength of the US economy is still there. We've seen GDP growth annualized at 2.8%. So even though there's weakness in the labor market or the jobs prints, actually the underlying health of the economy seems okay. And so, yes, the market had to digest that, and it had to feed into what was the Fed likely to do going through the rest of this year, which is an adjustment in terms of how we're looking at it today versus maybe a week or two ago. But actually the underlying health still seems fairly robust.
So if we think maybe concerns around the US economy are overdone, where should stocks be? What kind of landing in the US should they be pricing?
Yeah, so we think, look, soft landing economically is still the high probability outcome. Most of our current activity indicators still say we're going to trough out at 1 to 1.5% GDP growth. So this isn't recession where we have a real shift in Fed policy. We're going to see some normalization in rates. Our expectation now is we could see 3 cuts through the next 3 months to the end of the year. And the big question is whether the September cut is going to be 25 or 50. What that means for stocks is actually, one, we've taken a lot of the froth out of the market in the last week that was maybe there in parts of the market where the fundamentals were trying to keep up with that pace of momentum. But actually, the underlying health of the market still seems fairly robust. Where we're looking at right now is, can we buy some select tech names where the profitability, the cash generation is very robust and high, and the multiple has come back to us, and actually really into the small cap space, where we think the normalization of rates that feeds through into the interest expense, because this is floating rate debt, and the adjustment that can drive in the US economy should be very helpful for what is a still undervalued asset class.
Okay, we want to unpack some of those calls, particularly around tech. But in terms of your view, and I just want to meditate on that take around September and whether you get 25 basis points or 50 basis points, and how that ties into your call around small caps. Is 50 basis points more beneficial in terms of re-accelerating or reviving that rotation trade back into small caps, or would it smack of panic and concern about the health of the economy that you still see as facing that soft landing scenario?
Yeah, so let's just be very clear. I don't think there's panic in the sense of the Fed having to do something intra-cycle where we're actually having to see them come out and make an adjustment before that September meeting. But that 50 basis points would be an outcome if the data was still weak on particularly the job market. And so whilst we wouldn't say that's necessarily a definitive outcome, we think the Fed is going to be data-driven in the run-up to that. Now, how that plays into equity markets and specifically small caps, I don't think it has a huge bearing. Because simplistically, what we've been waiting for on the small cap side, and thinking of this more as a medium-term trade into the asset class, is that normalization in rates, because this is an asset class that, one, is heavily US domestic economy linked, and so anything that is positive in terms of monetary policy and drives the US economy growth rate should be favorable. And it's an asset class that has really suffered because of that higher lending rate and the fact that actually a lot of the small cap space, the SME space, is dependent on floating rate debt. And so as you normalize that, that should be very beneficial for margins, should be good for bottom line.
So that's a medium-term call rather than a tactical call on small caps US. And is that your clear regional preference when it comes to small caps? It's the US versus Europe?
At this stage, we do see a lot of opportunity across both. They're very heterogeneous asset classes, a lot of individual names we can find, but we think the cyclical upside in the US small cap space is very attractive. Now, what I would say, just as a data point, if you look over the last 20 or 30 years, from that point where the Fed has started to cut rates historically, you get a 12 to 15% outperformance of US small cap relative to large cap. And we're at this point of peak concentration in the US market. Obviously, we've normalized that a little bit in the last few weeks, but ultimately we're still seeing a big differential in valuation between large and small cap. And so catching up to a degree, we saw that in July. It's normalized in the last week or so, but actually that can be a really interesting starting point for a both 12-month, but also 36, 48-month trade.
Yes, and thinking about that time horizon, that takes us through some US politics, doesn't it? That kind of time span. And I guess a lot of investors are trying to invest for that kind of time span. And so they need to make sure that their portfolios are resilient to whatever might come their way. So how do you think about US politics? And I'm thinking in particular about some of the really popular themes that investors have thrown themselves behind. For example, AI, and maybe that stays intact. But around US manufacturing, around power grids in the United States, all of these trades, do they stay in place regardless of the views on climate, for example, of who inhabits the White House?
No, we actually wouldn't say that. I think there is a degree to which the last month or so you have seen a little bit of correction in the US market of people have digested a more clear and parallel race in the US election, because I think we'd seen, obviously, the outcome being a very likely Trump victory had become the normal expectation. So that's adjusted a little bit, and so people have had to factor into some of those trades you mentioned over the course of this year. Now, in terms of the longer-term themes, US re-onshoring, especially of high-end manufacturing, so, for example, semiconductors, is a structural theme that I think is bipartisan. If you look at the capital that's being invested via US CHIPS Act, if you think about what you need in terms of power supply as a function of AI model development and what you're seeing in terms of capital investment on IRA, these are things that are going to continue regardless of what you see on the political outcomes in November.
So even if the IRA, for example, is revamped under another president, you think that these investment themes that it sort of is the poster child for, they stand?
U.S. re-onshoring of manufacturing in some of those areas like semiconductors, we are very strongly of the belief will continue. On the power generation side of things, and especially around the renewables investment and the infrastructure and grid investment, again, we think that's critical for those AI development stories. It also is interesting if you actually unpick where that investment is going, it is largely into red or purple states where you've got a little bit more of a political lever into why would you pull that back if it's economically beneficial to some of those areas. So we think, again, that's a trend that will continue. We see a lot of individual opportunity at the company level, and this is just really the early stage of that cycle.
On generative AI, we have a reminder today from TSMC that it hasn't run its course in terms of the demand, at least for the hardware part of that story. Where do you invest within that ecosystem? Where are the opportunities? Is the focus on the hardware, on the B2B part, or the B2C stuff?
Yeah, so Tom, I think what we've said over the last 2 years is AI is transformational. Generative AI changes the way we operate, and so there's going to be a significant amount of winners that come out of that. But we also have to recognize the amount of capital investment that's taking place means you're going to get some pretty catastrophic losers as well. What we've seen thus far is it's the enabling technologies, the hardware businesses that have benefited from that significant uptick in capital investment. Your large hyperscalers are $800 billion of capex out of $1 trillion of S&P capex this year. So that is really a key driver.
For that extending out?
Now, I think that's a few more years where we're seeing that investment in model development. I think there is a little bit of a normalization coming, as we've seen in the most recent announcements and discussions from some of those hyperscalers, that will weigh a little bit on some of those hardware technology businesses. So actually, as we look at our portfolios, we've been trimming some of the positions within that as a function of where valuations have got to, and as a function of potentially more competition coming into that space. Now, I think as you extend it out over the next 3 to 5 years, the real question you have to ask is who in the software space is going to be able to utilize Gen AI in a way that enhances their product offering. And at the moment, where the market is having a little bit more challenge is trying to disentangle who that's going to be, because it's not yet clear.
Right, yes, and I wonder, that's really interesting, because I wonder what you're looking at to give you clues as to when this turns from just this big capex story into something that's really delivering at the top line and then dropping through to the bottom line for some of these businesses. And I don't really have a sense of the time scale involved in that.
Yeah, and I think clearly the market was wanting to see more, because you'd had on the enabling technologies, the hardware side, a lot of evidence that it was driving top and bottom line. And to a degree, you look at some of the earnings announcements we've seen in the last few weeks, the market is negatively assessing an inline earnings print because we're expecting to see constant upgrades. And so I think on that front, there is more to go, but we've got to be a little bit sensitive to that cycle. It is still a supply and demand driven model, and we're going to see some more supply coming in. Now, I think on the software side, it is a challenging discussion. What we're trying to do is think about who are the winners and the beneficiaries independent of who succeeds in that space. So if you think a little bit more tangentially and you say, right, cybersecurity is a theme as we increase the prevalence and reliance on some of these technologies, again, becomes something that's a structural investment.
Yes, you see, well, that was interesting, because I remember a few months ago, we were talking about actual diversion of capex spend, or rather tech spend, actually, from cybersecurity into AI. I think we had some numbers out from some cyber businesses that disappointed at the time that NVIDIA was really flying, and people were saying, oh, this is a reallocation of tech budgets. But you say that the two will go alongside each other.
I think they have to. I think we know that cybersecurity investment and the strength of an individual company's technology ecosystem and architecture is going to be crucial to their long-term success. So yes, there's been a little bit of cyclical normalization because some of that capital investment has had to go into keeping pace on that AI model development trade. But actually, medium term, we still think the cyber trend is here to stay.
Look, just looking back at the week that was, and we're in a position now, we're hearing of a number of voices saying, look, this is all a head fake. But there was that real panic on Monday. If you want, you're still constructive on these equity markets. If you want to put a defensive trade in play, where does that take you?
Well, so I think a couple of points. One, we have seen defensive, high-quality businesses outperform. They've lagged for much of this year. And so you have seen some outperformance in those areas where, look, in a period of panic and stress, they should do relatively well. Now, what we're trying to look at more holistically is where can we find strength in fundamentals? Because actually in the last couple of days, yes, we've seen a correction and that move upwards, but it's been fundamentally driven. And so actually market is looking at where businesses do have strong earnings outlook, can turn that into positive cash, and actually can deliver for underlying shareholders. Now, I think just more macroeconomically or globally, the area that we're finding a lot of interest, and interesting in terms of how it's traded in the course of this week, is India, where you have macroeconomic visibility of 7 to 8% real GDP growth over the next 5 to 10 years, and an underlying domestic demand-driven economy that's feeding into the capital market. And so, yes, it's a little bit tangential from everything we've talked about thus far, but that's a market that we think is very resilient. Yes, there's economic linkages through the commodity markets, and if we see a big spike in oil, that will always weigh on India in the short term. But actually, if you look at what's happened in the last week, that still feels really healthy.
Okay, Luke Bars from Goldman Sachs Asset Management on the relative resilience of India in this environment, and a call around generative AI as well, continuing to be a place to look for those investment opportunities. Luke, thank you very much indeed. Let's check in on the Core 6 then this Friday, of course, and they've been challenged as well in this volatile week. And we check in on some of the pricing action coming through. You can see ASML, of course, is in the mix. The linkage is there to the optimism and the sales numbers coming through from TSMC, of which, of course, it is a major client. ASML then up 1% so far in the session. A couple of other standout names, Novo Nordisk, Eli Lilly. Wow, the shares surged yesterday on how they're positioning around these obesity drugs. Novo Nordisk, of course, the key competitor, gaining 1.3% so far in the session. Just one of those Core 6 in the red. Nestle, not by much, just down 0.1%. Let's check in on some of the other individual stocks on the move with Joe Easton. Joe.
So we can see Hargreaves Lansdown shares coming up closer towards the bid price that they have agreed. It's about £11 a share. Now, this stock was trading around £8 a share for the past couple of years. But if we go back to the pandemic, it was almost at £18 when the real peak in trading, online trading at home was. So it is below that, but a decent premium over the past year or so. Now, the other one we've brought up here is Evolution. This is in Stockholm, the gaming gambling company. Our bureau out there reporting that a billionaire has taken a 5% stake in this. It's a US-based billionaire. We're seeing a little bit of a gain there, but the big one, Hargreaves Lansdown, up around 2%, a 50% gain over the past 6 months or so. Then in terms of earnings, some decent moves coming through. Generally, this one hit by those claims on natural catastrophes, particularly flooding, as you were discussing earlier. That one is one of the worst performers in Europe today. And on the upside, we've got Leg Immobilien, and this is over in Germany, real estate, seeing a bit of a rebound in some of their property valuations. That could be a potential marker for that sector going forward. And then Larxis in chemicals, also in Germany, doing a bit better in terms of some of their volumes. But we have got Eutelsat over in Paris getting hit today. That's the worst performer on the Stock 600. They're reporting weak orders in one of their internet infrastructure businesses. This is a satellite company. Recently did a deal in that space and seeing some weak numbers out of them this morning. So some pretty good moves for what is a bit of more of a quiet day in terms of earnings day. But we have got some good movers on there. In terms of Italian banks, news out of local press today is that Italy might be looking to tell banks to give more money to customers who have savings accounts with them in terms of passing on the interest rate increases. That's sort of something we've seen over the past few years, but it seems to be a new issue over in Italy. But we're not seeing too much reaction, actually. Most of those stocks moving slightly higher with some of the broader financial sectors today. And I'll check in on the chip stocks. You mentioned TSMC, Tom, with that massive jump in orders in the latest month, up around 45%. Potentially that's feeding through into some of their clients like ASML, also BE Semi. Infineon, meanwhile, there is comments out of this company today saying that they're looking to do potential M&A, saying that they could have a couple of $2 billion to spend. That is interesting from them. They had some results recently, but green on the screen in terms of the chip makers this morning. In terms of your best performing stock, we have got Just Eat. We mentioned earlier the takeaway company is overweight now. This one at Morgan Stanley. They like it on potential reduction in fee caps in New York. Also the grocery business, and that stock up 4.7%. Morgan Stanley is overweight on that one. I'm going to get to JP Morgan because that was the next one. They are overweight on Galderma. You might remember this one is the company that L'Oreal took a stake in recently this week. It's the injectable cosmetics company over in Switzerland. JP Morgan goes overweight that one, and it's up 2.8% over in Zurich this morning.
Joe, thanks so much. Joe Easton with a rundown of some of the stocks on the move. A lot less by way of earnings this morning. Fewer companies giving us their earnings reports, but still plenty of stocks on the move. A bit of M&A in the mix. We also have some macro drivers to think about in Asia coming up. China's CPI picks up, but demand concerns persist in a gloomy sign, perhaps overall for the Chinese economy. We'll discuss that next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep winning the World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back to the opening trade. Happy Friday. 20 minutes into the session. You're seeing modest upside coming through for European stocks, up 0.3%. US futures have turned as well into positive territory. Some data came through from China. It was welcomed by the markets. Then they gave up the gains, and the CSI 300 ended down about 0.3% because the headline number came in higher than expected in terms of inflation. That's what policymakers want to see, an increase of 0.5% higher than expected. But you lift the hood and you realize that it's not all that it necessarily seems when it comes to China's inflation trajectory. Let's get more then on this story with Bloomberg's Balazs Pence with the details. Balazs, what does this data then tell us about the current state of China's economy and whether or not consumers are feeling a little bit more optimistic?
Well, as you said, the whole name of the game in China is demand. And like you said, when the number first came in, it seemed very positive on the surface, CPI beating expectations finally. But when we drill down, we see that that was a result of food prices rising, which was almost entirely driven by the weather. It's been a very hot and wet summer in China. So when we look at the products that actually help us measure demand, like cars and consumer electronics, smartphones, and appliances, we see that those prices are actually still falling. And as we saw, core inflation is actually the slowest since January, and producer prices are still on a downward trajectory. So that suggests all of that put together tells us that demand still continues to struggle in China.
Right, so demand continues to struggle. And so how will policymakers respond, Balazs? We've seen the PBOC attempt to do things. We've seen plenaries take place where policy announcements were made, but market voices suggesting it wasn't enough. So what are policymakers thinking?
It certainly appears that Chinese consumers have so far been impervious to the stimulus efforts. It's widely expected that the response will come in both the monetary policy and the fiscal policy front. In monetary policy, it does look like the PBOC has more room to cut, especially if the Fed moves aggressively. There are some analysts who now expect as many as 3 more rate cuts in China. And there are other things they can do. There could be more immediate measures, like an adjustment in banks' reserve ratios. On the fiscal front, the government last week announced a 20-step program to encourage more spending, to encourage more consumer demand. Unfortunately, we don't yet have a lot in the way of details that tell us about the shape of that package or how the government intends to fund it.
So a question is, and this has been a question all year really, Balazs, as you know, is whether or not these measures are actually going to work, because we've heard the rhetoric from Chinese policymakers, we've heard and seen some of these steps being implemented, but so far he hasn't really moved the dial. What is the expectation from you, the team, investors, economists, as to whether or not these measures this time will actually make a difference?
Well, as the evidence shows us, it's really hard to move the needle on the short term. And so far, like you said, the measures that they have undertaken have not had a huge effect. Certainly, we do know that the government has stepped up borrowing, so they do have a healthy war chest if they do want to embark on more stimulus. And the conventional wisdom is that it will take something quite impressive to change consumer sentiment. But if that does happen, there is a chance that consumers will start spending more, opening up their wallets. For now, though, it looks like the gloom is here to stay.
Okay. Thanks so much. Thanks, Balazs. Bloomberg's Balazs Pens with the latest on the Chinese economy. Let's pivot from the Chinese economy to Chinese diplomacy, shall we? And soft power. And yes, we're back to talking about pandas again, a topic we have visited in the past, Tom. It seems that a new home has been created for some pandas coming from China, on loan, of course, as they all are. We've had that conversation before as well, at San Diego Zoo. I was interested in the detail that Ken Griffin and others at Citadel are partly responsible for funding this return.
Yeah, so we don't have a number from Citadel, or from anyone, in fact, from the zoo in San Diego, which, by the way, is a fantastic zoo if you ever get the chance to go. But he is apparently supporting this effort. So the diplomacy is important, of course, when it comes to pandas. You have to wonder how long they're actually going to be there, given the politics of the US and what happens after November, of course. I also have a question as to whether or not we should be spending all this money protecting pandas, frankly, because they're cute and cuddly, but as a creature, they're just pretty rubbish. So they depend on, they have to eat 40 pounds of bamboo a day. Bamboo's only found in certain regions, of course, in Sichuan, around Chengdu. I've been there, I've seen them. They're lovely, but they don't do much for the ecosystem. They're very, very bad at breeding as well.
They are.
And if you spent more of that money on things like, let me give you some examples, the yellow-faced bee, ever heard of them? The Snake River salmon, they need our help, they're facing extinction.
You're making the point that we shouldn't just look after the cute and the cuddly.
Yeah,
is
exactly.
that the thing?
That's my campaign.
That's a serious point. Ken Griffin apparently does a lot for the conservation of Komodo dragons and iguanas as well. He has places named after him in the United States for conserving these creatures. So
okay, Griffin's doing his bit.
There we are.
Around conservation and panda diplomacy as well. They're the pics. You can't get too many pics of the pandas.
You can for Tom, apparently.
Even if they do need to be just...
yes. Careful how you end that sentence. Coming up, it was a bumpy start to the Olympics. We'll look at the major sporting moments, of course, and what will be the legacy of the Paris Games. We have the closing ceremony taking place this weekend. We're not quite done with the action. What on earth will I be watching in the late afternoon after European markets close? After this week, all I've been doing is watching the Olympics. So we will talk about the au revoir in Paris to the Olympics, and we'll see where the city has benefited, what it has gained. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. We are 30 minutes into the Friday session. European stocks currently up 0.3%. And here's some good news. If you are on Wall Street or invested in an investment bank, or working in an investment bank, I should say, because Wall Street bonuses, according to our reporting, set to jump by as much as 35% this year. And bankers who help companies sell debt expected to see the biggest payouts. They could swell bonuses by as much as 35% if you've been involved in underwriting deals in the debt markets. In terms of equity underwriters, they could see gains of about 30%. But across the board, bonuses are expected to jump. Barclays as well, also making some moves after we removed the cap here. The government did, at least,
in the UK,
in terms of bonus caps here.
Yeah, so that data on Wall Street coming from Johnson Associates, and they're talking about that possible 35% pop. And you're right, it's different in different sectors, but they talk about debt underwriting. Also, you know, equity market M&A, if we are going to go back to that, we were talking about private equity with dry powder and wanting to get deal flow moving again. So we'll see whether that comes to pass, especially if rates drop a little bit. But on the UK side of things as well, yes, this Barclays move follows others in the sector, doesn't it? And it's a year ago since we got the then Conservative government removing the cap. It was a European Union legacy policy. They removed it, and the Labour Party said at the time they wouldn't oppose that or stand in the way of it, or reverse it, rather. Once they came into power, they did come into power, and so no sign that that changes. So now we could see bonuses at Barclays going to 10 times earnings for some risk takers, a very narrowly defined group of people, I think. So we could see that. Of course, that won't be the case for most people at Barclays, but that is what we're learning about the bonus story.
Yeah, potentially 10 times, as you say, base salary for those at Barclays within that category. Goldman Sachs, JP Morgan, as you say, also removing that cap on bonuses.
Okay, let's talk about the Olympics a little, shall we? 8:31 here in London, 9:31 in Paris, and the Paris Olympics wraps up on Sunday, which has been globally seen as quite a success, with spectators enjoying iconic open-air competition venues at the Eiffel Tower, Versailles, and across along the banks of the Seine. But after the Games, what will be the legacy for Paris? Time to start thinking about that a little. Let's bring in Bloomberg's Benoit Berthelot, who is in Paris for us, has been enjoying, I'm guessing, enjoying the Games. Maybe not. Maybe it's not your favourite thing, Benoit. How good has it been for Paris, though? How much benefit has it brought to Paris?
I did enjoy it a lot. I've seen many of the games. Yeah, it's been great for Paris. Look, people have been a bit skeptical about the games beforehand because they were told it would be difficult to move around. There could be security issues, etc. None of that happened. Quite the contrary. Like it's been good for the city in terms of security, transports. So far, some Parisians left the city and are now coming back to enjoy the rest of the games because they don't want to miss out the party. And of course, many visitors from around the world have been here, sort of replacing the usual tourists coming to Paris during the summer. So all in all, it's not a massive increase of people coming, but it's different tourists spending more as well on these Olympics. But obviously the mood is great in France right now. It's been a few months of very difficult political issues that are now sort of on pause during the Games.
Yeah, the mood, and everyone I know who's been there has said that the mood is fantastic on the streets and around the venues as well. Benoît, what do we know about the impact on business then, business in Paris, business in France, and the global sponsorship element of that? What do we know about the economic impacts of this?
Yeah, so of course it's a bit early as the Games are wrapping up on Sunday, but it's been known for every game that during the event, of course, there is some business that are doing very well, because they are clearly benefiting from the Games. Other ones are sort of blocked from their business as usual. But the data we have, for example, from Visa, who is a partner of the game, they saw 26% of increase of sales for the small businesses in Paris. And there are many sponsors who are hoping to benefit from the Games. For example, LVMH, probably the biggest of them, spent 150 million euros on the Games, and they certainly wanted to make the most of this sponsorship, were showcased in the opening ceremony quite heavily, are spending a lot of ads, etc. So these types of companies certainly want to see a longer impact of the game. Now, there are others like Airbnb who just saw mixed results globally. So it's sort of an investment for these companies. They're hoping that more people will come to Paris in the following months and years. Same for example, Disneyland in Paris. Disneyland has said that the games sort of disrupted the normal interest in their parks, but it's sort of a longer term impact that could be expected.
Yes, you certainly, the closer you looked, the more you saw LVMH, for example, in different parts of the Games, like the medal ceremonies, for example, and I just see orange shoes everywhere. I mean, this is also one of the marketing pushes, perhaps, at this Games from those makers. Let me ask you about the legacy of the Games, then, Benoît. Let's get to that, because I mean, back in 2012 in London, this was a big conversation, even satirised in comedy shows. The legacy of the Games, what would it deliver? What is the thinking in Paris about how long-lasting positive impact will be?
So the Paris tried to do lower-cost games, right, with all these venues that are temporary, that were in the heart of the city. Few stadiums have been built, only one small stadium and a swimming pool. So it's mainly two areas that have been built for the Olympic Village. Some other installations, that's going to be new housing in these sort of newly developed areas of Paris. And then there were many improvements in the transport system, for example, that have just been ready for the Games and that people are going to enjoy afterwards. The biking lanes, etc., are also post-COVID new features of Paris. And then there is the Seine River. Paris invested a lot in improving the quality of the Seine. It's just been ready for the Games. In the end, they were able to swim in the Seine, but that's going to be a benefit for the city for the years to come as well, people hope.
Okay, yes, they were able to swim in the Seine, not always on the days they had planned, but anyway, it happened. Benoît, thank you very much. Being both Benoît Berthelot in Paris for us. Let's turn to, in fact, I should tell you that coming up next hour, we'll be speaking to the Amazon Web Services EMEA Managing Director about that company's involvement in the Olympics. So keeping with that Olympic theme, that's at 9:40 a.m. London time. Let's get to then, Tom, some of the movers that we have on markets this morning. Yep. It's not a day for many individual standout stories, but we certainly have some M&A in the markets, and Hargreaves Lansdown is one of those. We see CVC and Adia agreeing to buy Hargreaves Lansdown in a £5.4 billion deal. The stock is up by 2.2%, we see, as a result. That's the move that we're seeing in this, private equity suitors coming after this UK investment platform.
Yeah, and in the semiconductor space as well. So tech getting a bit of a lift in Europe today, and you can link that back to TSMC because the contract manufacturer of semiconductors came out with sales numbers earlier in the day. Those numbers in the month of July growing 45%, and the company saying that was largely down to continued strong demand for those AI chips. So companies linked to TSMC, like ASML, getting a bit of a lift this morning, quite modest, but up 0.6%. Of course, that company provides much of the hardware that TSMC needs to churn out those chips. And ASM International, ASMI, also in the Netherlands, gaining as well in the session, 1.8%. So the tech and the chip makers here in Europe getting a bit of a lift on the back of those numbers coming through from TSMC.
Yeah, so that's tech, the read across in the NASDAQ and the TSMC story, as you say. Let's talk about Generali in the insurance space. A second quarter profit drop, 24% from a year earlier. Claims from storms and flooding in Europe are the negatives. Those are the things that weighed on the numbers. So as a result, you see the stock is down by 1.7%. The CEO says that he's focusing on insurance segments with high margins as he's seeking to follow through on a pledge to achieve annual earnings per share growth of 6 to 8% in 21 to 24.
From insurers then to groceries, takeaways, Just Eat is up, as you can see, 4.4%. One of the top gainers, in fact, of the session after an upgrade from Morgan Stanley, raising their view on Just Eat to overweight, raising their recommendation to overweight. They set a price target of 129, so it looks like an increase of about 24% from the last price. And investors welcoming that upgrade coming through from Morgan Stanley on Just Eat takeaway. Coming up, Donald Trump and Kamala Harris. Well, they finally agreed to debate. It's taken a bit of wrangling as the Republican, of course, is looking to shift the race for the White House after arguably Kamala Harris has hogged the limelight over the last week or so, and Trump has tried to reset that, and they're agreeing on this debate as well. The details on all of that next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Democratic nominee.
We're in Atlanta, Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but that's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that, and they're like, oh my gosh, this could actually happen, and I could be a part of it.
Okay, you can read more of our Big Take story on swing states online at Bloomberg.com or, of course, on your Bloomberg terminal. Now, Republican presidential nominee Donald Trump has agreed to debate Democratic rival Kamala Harris in September. Speaking with reporters at Mar-a-Lago, Trump criticized Harris for avoiding media interviews since securing that nomination.
She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it, and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
Okay, and that was Kamala Harris speaking on the question of that debate and saying she would agree to it. Still waiting, of course, for the final details as to where that lands, but we are reporting that the Democrats and the team around Kamala Harris have refused, at least ruled out, that debate taking place on Fox. Let's get more on this story and how the politics has evolved, as it does rapidly in the US right now, with our senior writer at Bloomberg, Stephanie Baker, who keeps, of course, a firm and close eye on all things US politics. So Harris and Walz pulling in these huge crowds, and our team on the ground who have been attending them saying that they do compare to the kind of rallies that you see and the kind of enthusiasms you see from Trump rallies. Certainly a long way from what Biden was pulling in terms of the attendance, the enthusiasm. You have celebrities on stage as well in the warm-up acts. Is this sustainable, do you think?
Yeah, it's really interesting because people are now comparing the kind of crowds that she's pulling in to the enthusiasm behind Obama in 2008, that we haven't actually seen this kind of energy in the Democratic Party for over a decade, almost 2 decades even. So I think that it's a question, can she keep this up? Obviously, you win elections not just by enthusiasm and energy on the campaign trail, but at the ballot box. So, you know, the crowd size, you know, doesn't matter that much at the end of the day. So I think it's important to still keep an eye on the polls.
Yeah, it reminds me of when you go to party conferences in the UK and people say, well, it went down really well in the room. And you think, well, of course, it goes down really well in the room, but it's how it goes down in other places that maybe matters more. Critics then complain that Harris has avoided interviews. We just saw her taking a few questions on the tarmac there. Is this a valid concern? Is she not answering questions that people have as frequently as you would expect somebody to in this position?
Yeah, well, the Harris camp response to that is that she's only been the nominee for 2 weeks, and she's had a very busy schedule. She had to pick a VP. She had to, you know, plan for the convention and plan to introduce, you know, Walz to the nation, and that she will be giving interviews in due time. So we'll wait to expect that, you know, in the coming weeks, perhaps after the debate. I'm not sure, you know, maybe before. I think the real question is, you know, how does she perform when under pressure on the big policy issues? Can she keep up that kind of momentum that she has on the stump? She gives great speeches at these rallies. She's really able to kind of, you know, rile up the crowd behind her. Can she withstand the pressure under scrutiny?
And we'll get a better sense, I would assume, of that question when they do this debate, and it's been agreed. So September the 10th is the debate time, and we've obviously been reminded this year of just how crucial those debates can be. What is your thinking around that and how that could evolve, how consequential that could be?
Well, you know, the political roller coaster that we've been on for the past month has just taken everyone by surprise with twists and turns that no one could have predicted. The debate is obviously very consequential, could be as consequential as the debate between Biden and Trump that upended the race. I think both Harris feels confident and has been demanding Trump agree to this debate. Trump finally did, in fact, agree to it. Is he able to stick to the script, or does he go off into meanderings like we saw at the press conference last night and attack her in a nasty way that backfires on him? That's the thing to watch.
Yes, and talking of that press conference yesterday, what did you take away from that? From the market's perspective, a lot of focus on things he said about the Fed and how he should have other presidents, but also just him, how he should have more of a say on what interest rate policy looks like in the US. But away from, I mean, is that what you took away, Stephanie, or were there other things to watch?
It was so meandering, and he lied so many times. Everything from, boasting. He seemed obsessed with his crowd size, and I think that the crowds that Harris has been able to pull out seems to have really rattled him.
And that goes right back to when he was first inaugurated, doesn't he? I mean, that was a big debate.
Exactly.
The size of the crowd that attended that.
And the most incredible thing is when he compared his January 6th crowd size to Martin Luther King's I Have a Dream speech, which people thought was really, beyond the pale. I think some critics are saying that the sign that he called this press conference is the best signifier that he is really rattled by the Harris campaign and wants to try to regain the limelight and feels comfortable giving these sort of meandering press conferences as a way of, regaining attention.
Stephanie, thank you very much. Thanks for joining us. Bloomberg senior writer Stephanie Baker, all across the US politics for us. Maybe we've taken our eye off that a little bit, given the volatility we've seen in markets over the past week, not driven by US politics. Maybe we leave that for the run-up to November. Plenty of time for that, of course. With thinking about that volatility in markets, the Monday mayhem, the Tuesday turnaround, Wednesday's whipsaw, what was Thursday? I've forgotten what Thursday was. Turnaround Thursday, takeoff Thursday.
Takeoff Thursday.
I think that was it, yes. And maybe flat Friday is appropriate. Certainly looks like it for this hour of the day, although it is very early in the States. But US futures are pretty flat. We're through some of the big data points of the week, so we will keep an eye on those, though, as we get closer to the US session. Bloomberg's Connor Cooper joins us on set with thoughts on the week that was, and what a week it has been, Connor. Nice to see you.
Nice to see you.
Market volatility then, Monday we had lots of it, and the VIX took off to levels that seemed kind of crazy compared to other periods of risk in the last 20, 30 years for US markets. What did you make of the volatility story?
Yeah, it's sort of a whole month's worth of action crammed into one day. I don't think we'll see many days like Monday again. What I do think we will see, though, is... sorry.
That's okay. Go ahead.
What we are going to see is that move's going to be sort of spread out. The direction of the move is probably going to continue again. We saw, because the reason the move happened, the three reasons... Sorry, I'm feeling a bit unwell.
Okay. We can maybe cut it short.
Take a breather. Yeah, it has been a big week. But
it's been a big week.
It's been really challenging, and you've gone through, of course, this week, Anna, for us in terms of just how things have adjusted on the equities front and fixed income as well, and the turnaround, and now the adjustments in terms of the views around the Federal Reserve. And we'll get a better steer of that, of course, next week when we get that inflation data out of the US. It's going to be really consequential. The retail sales number as well out of the US in terms of what the consumer is doing stateside and how much strength that they still have. And here in the UK as well, inflation out of the UK. So it's not going to be a quiet week next week either. Unlikely to replicate the kind of moves we've seen this week in terms of those spikes around volatility. But again, consequential in terms of getting more clarity, we hope, in terms of where these central banks go from here and how markets adjust.
Yes, absolutely. In terms of what we're looking at next week, you've been through some of these topics. We've got the inflation prints on both sides of the Atlantic, as you say. CPI in the United States will no doubt be in focus. We had that labour market data that shook confidence on Friday. And then yesterday, we rediscovered some confidence thanks to a week of jobless claims. So there's a lot to think about there. Although I really liked the line from our UBS guest earlier on today, Tom, talking about how the whole thing has just been one big head fake.
Yeah.
We overdid concerns about the US economy at the beginning of the week, and that's really what led us into this whipsawing that we've seen. But then it's not only in the US we'll get the data. The UK will have inflation data here as well, and the wage story. The inflation data will be interesting because it will tick up. That is the expectation, and a lot of that is due to fuel prices, and it's a sort of base effect effect of fuel prices, but it's services inflation that really matters more. So, yeah, we'll be looking for clues for the BOE there.
And the tension has been there at the MPC, hasn't it, between the hawks and the doves? It's very, very finely balanced. They went with that cut, of course, so you're back to 5% from 5.25%. But to your point, will stronger inflation data out of the UK lead to a question mark as to how aggressively the BOE can go from here? You were talking about the head fake line from our UBS guest. We were hearing from our Goldman Sachs guest as well in terms of the historical perspective when it comes to the start of these rate cut cycles from the Federal Reserve and what that means for small caps. And he was quoting a number. Historically, you see gains, I think over a 12-month period, when the cuts start for small caps of between 14 and 15%. UBS and their CIO of Wealth saying that if you look historically, you see gains for the S&P of about 17% historically after the start of cuts. And that's why at UBS they remain constructive on these markets.
Yes, they were saying 3 months, 6 months, 12 months. It all looks favourable for stocks when you see these bouts of volatility. So we've had a lot of debate then about the US economy and whether those cracks really are taking us to a hard landing or whether a soft landing is still in store. Let us recap what we've heard from some of our guests talking about the possibility of a recession in the US.
I do believe there's resilience in the U.S. economy.
We do not yet see any sign of having the economy move in recessionary territory.
There have been several calls for U.S. recession. In fact, they've just turned out to be corrections with a resumption of growth.
I do think that we're getting a correction here after a very strong run on the markets, and that might be healthy.
We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set.
We probably all have to live with more volatility than we are used to. But overall, I think the trend is our friend and the trend is showing upwards.
Ahead of the elections, obviously, maybe the market is a little bit muted. But all in all, the United States was always a market which was quite resilient.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
The economy will chug along, and we probably won't see a recession.
Some of our guests there talking about the possibility of US recession. Interesting then, Tom, that we had comments there from European corporates like Siemens saying emphasis on the resilience. I should also point out for viewers who are wondering about Connor, he's okay. He's gone back to his desk. So Connor Cooper, who we brought on briefly, is okay. But that's the story then out of the US economy from the European corporates right now. They put the emphasis on resilience.
Yeah, and the sense is, again, look, don't write off this US economy. And again, from Goldman Sachs Asset Management, our guest earlier saying, look, even if you move lower in terms of growth for this year from 1.5% to 1%, you're still getting decent growth. The jobless claims yesterday, of course, led to the market rally that we saw with the S&P notching gains that we haven't seen the biggest pop since November 2022 because the jobless claims were slightly lower than the estimates. So again, the labour market, yes, it's seen a few cracks, but a number of our guests have said there is still that resilience there. You're not close to that recession, even if, of course, JP Morgan, Goldman Sachs have increased their odds, their chances of a US recession. It's still not the base case.
Okay, so that's not the base case. In terms of the movers then today, we've got some upside in Hargreaves Lansdown, private equity coming in for that business. Of course, we've seen that have an impact up by 2%. The tech sector in focus as well, Tom?
TSMC coming out, of course, over in Taiwan, but there's the tie to the European players, the providers of equipment, of course, to that contract chip manufacturer. They came out with some really decent sales numbers suggesting that demand for generative AI is still there. So the likes of ASML and ASMI over in the Netherlands are getting a lift on the back of that story.
Okay, those are the movers then this morning, this Friday. US futures flat, yes, but a little bit more positive than they were. So we'll keep an eye on those as we bring this incredibly busy week to a close. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Questioning the Fed's independence, Donald Trump says presidents should have some say over interest rates and monetary policy, while he and Kamala Harris agreed to debate in September. European stocks are higher after encouraging data on the U.S. labor market. That's after the S&P actually notched its biggest rally since November 2022. Plus, the billionaire owner of e-commerce giant Temu becomes China's richest person. So good morning, everyone. Happy Friday. We've just about made it through the week. It was a pretty tumultuous week. So let's take a look at what the European markets are doing. Overall, we're seeing a little bit of gains across the board. Again, it's been up and down since that big Monday sell-off. For the moment, the CAC 40 gaining some 0.6%. The DAX gaining 0.4%. Again, if you look at U.S. equity futures, they've actually erased earlier gains. The S&P notched its best daily advance since November 22 yesterday. This is a picture overall. We look at yen 147.28. I have to say, if you look at the global stocks rally, it does seem to be losing a little bit of momentum. The yen resuming its rise earlier on, stoking, of course, renewed worries about the unwind of the carry trade after this nascent recovery that we saw over the last couple of days has also been driven by signs of resilience in the U.S. labor market. We also look at Brent 79.14. So for the conversations that matter and the insights you need, let's get started.
Makers and market movers. This is The Pulse with Francine Lacqua.
So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. The Republican presidential nominee, Donald Trump, says the president should have some say over U.S. interest rates and monetary policy.
Thank you very much. Appreciate
Now, such a move would go against the long-standing practice of keeping the Fed independent from political actors. Now, Trump has repeatedly complained about the issue and criticized Chair Jay Powell for being both too early and too late on moving interest rates.
I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Let's bring in Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Wei, thank you so much for joining us. I remember, all of these memories about, Donald Trump calling the most valuable player or improved player, and Jay Powell, you appointed him, but then are we going to see that again if he's president? And are we actually talking about the central bank possibly losing independence?
Well, this was reported a little while ago as well, that Fed independence could be challenged in a Trump administration. And then markets got nervous, but then it then moved on to the other kind of drivers. So I think there is a risk of that as we think about kind of scenarios that could play out. And I also think that plays to kind of what investors ought to demand for holding government bonds in portfolios, because if we're talking about this being in question, then term premium needs to increase, and term premium anyway needs to increase to reflect the steeper fiscal trajectory that is going to kind of be the reality that we're looking at, no matter who gets in the White House. So all of that goes to show that we need to think about portfolio construction around treasuries more carefully going forward.
And I mean, what's also crazy when you think about it is actually the debt is not part of this conversation. And I know last time we had in the UK the Liz Truss government going after central bank independence, and then there was that disastrous budget. Could we have a perfect storm where actually an auction goes badly in the US?
Well, nothing is kind of ruled out completely, I would say. And if we look at, yes, you talked about auctions, the 10-year auction this week, the 30-year auction, both saw a bit of a tepid demand, and we saw yields kind of higher than what was expected as logged in the auction. I would say, though, there are so many other factors at play. We need to think of it as a whole portfolio. So whilst the demand for long end of the curve may not be as strong because of the considerations that we just talked about, the demand for income is still firmly in place. And we have seen one of the biggest inflow weeks into fixed income products, especially in the middle of all this volatility. So income is back, and there is a place for front end of the curve, value of the curve. And look at credit. Credit has held up incredibly well in the middle of all this summer volatility and summer market correction. So I think we need to kind of think about fixed income in a differentiated way. Term premium for long end treasury needs to go higher, but it doesn't mean that it has to be a perfect storm for fixed income.
So what's your take? I mean, what a week we've had, right? We started Monday, and it was a confluence of things, and we thought we'd be stabilizing a little bit. Then we've gone off the day's highs, I think, yesterday. Are we going to see these bouts of volatility being built in more into the system?
Well, I think if you ask me, or if you tell me on Monday that we're going to see U.S. equities closing the week almost flat, I would have thought, well, how is that going to happen? And here we are. So I think summer anyway generally is accompanied by lighter liquidity, and this together with worries around recession, labor market, worries around Bank of Japan losing the plot with their policy normalization, really exacerbated the technical side of things. But I think especially at times like this, it's important to look at, is the fundamental picture really changing? You look at earnings. Earnings are actually coming in really strong. Q2 earning U.S. equity market were tracking 14% year-on-year growth versus 9% expected at the beginning of the quarter, at the beginning of the reporting season. And even for the non-tech part of the U.S. equity market, expectation was for them to grow 2% year-on-year, and now we're tracking 5%. For tech, expectation was for them to grow 18%. We're tracking 20%. So earnings are coming in quite strong, but it's easy to forget that when we're talking about market volatilities like what we have seen so far this week.
I mean, partly, of course, it's the carry trade, partly is expectations about a recession in the U.S. Have you changed your expectations at all?
No, not around kind of a recession. I think growth is slowing down. That is required to cool down inflation. So that is always in our kind of economic forecast. But we're not forecasting a recession, and we're certainly not forecasting a recession because of the sign rule, because of the rise in unemployment rate, because the unemployment rise can be explained this time by really labor force, labor supply increasing. Since 1970s, the sign rule hasn't been triggered without employment falling within 1 month of the rule being triggered. This is not what we're expecting. This is not the environment that we're in right now. If you look at what triggered the recession fear last week, is the manufacturing print, is the NFP print. But since then, that has given way to a more benign reading of the SLOOS, the Senior Loan Officer Opinion Survey, service strength, as well as the jobless claim yesterday that came in better than expected. So I think it's easy to get quite nervous in the middle of summer in this air pocket, but the fundamental picture hasn't gotten worse, and that's why we reiterated our overweight in U.S. equities in the middle of this market volatility.
So have you changed any of the weightings when you're building portfolios?
Not right now. Not right now. We continue to like tech. We're looking at NVIDIA reporting on the 28th of August. We're also continuing to be positive on U.S. equities. Japanese equities on the currency hedged basis, we have the conviction. I would note that currency, well, actually on the currency unhedged basis, we continue to have the conviction. I would say that currency play, currency overlay has helped our Japan core in the middle of this yen-driven equity correction. Even in the middle of Monday's volatility, MSCI dollar currency unhedged Japan equity was just down 8% from the peak, right? So there is a bit of an auto hedging component, and we see domestic earnings recovery story continuing as well, which is why we reiterated our conviction.
Wei, thank you so much. Wei Li from BlackRock, of course, stays with us. We'll talk a little bit also about China and some of the other things that we could see in portfolio building in Europe. Now, coming up, Chinese stocks rise after inflation increased more than expected. So we take a look at the world's second biggest economy next. And this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Now, investors still concerned about sluggish demand in China, despite inflation in the world's second largest economy increasing more than expected last month. Now, Wei Li from BlackRock is still with us. Also joining us, Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. So, Wei, thank you so much for staying with us. Gina, welcome to the Pulse. I mean, there's been so much going on in terms of U.S. equities. What have you been hearing from people on the ground? Is now a good buying time, or are we buying the dip, Gina?
Yeah, there's a lot of nervousness still around the U.S. recession and what the Fed may do about it. And I think that this is a particularly complicated time for U.S. equity investors because a lot of what's happening in U.S. equity markets is actually being driven by policy, and not necessarily just U.S. policy, but Bank of Japan policy in particular. If you go back to the middle of July when U.S. stocks peaked and when the broader global equity markets peak, that peak was clearly manifest through a shift in direction from the yen, and then exacerbated when the Bank of Japan started tightening for the first time in 2 decades just last week. So the Fed is really playing a big role here, and not necessarily a very traditional role with respect to U.S. conditions, because as the Fed tries to potentially fight off recession in the U.S., they may have unintended consequences of exacerbating the Japan carry trade that's been unwinding and creating a lot of distortions in U.S. equity markets as well as global equities. So that's really what people are very concerned about, is how much of the recent weakness is really related to U.S. weakness versus just weakness in with respect to this carry trade unwind, and how is the Fed going to approach the markets going forward?
Wei, how difficult is it actually to see how much of the carry trade has already been unwound? I think I saw we're 65% there, we're 70% there. Could it be more?
It's very hard to size the quantum of carry given the OTC nature of some of those hedging instruments. But I have also seen reports of, we're halfway through, we're 3/4 through. I think the expectation shouldn't be that we're going to go all the way to everything getting unwound. We're still talking about rate differentials between US and Japan. An interesting chart I was paying attention to was to look at the real rate differentials between US 10-year and Japan JGB 10-year and how dollar-yen has been tracking. There was a disconnect that opened up 1 month ago, and now that is largely kind of closed. So looking at all of that, I think it's fair to say that maybe the worst of the carry unwind is behind us rather than in front of us, especially in the context of Bank of Japan actually walking back from their more hawkish than expected policy normalization stance. Last week, for them to introduce currency as a consideration in their policy making is highly unusual, which is why they saw what happened to global markets through carry dynamics this week. They then came out to say that, well, if there are worries in financial and capital markets, they're not going to hike rates. So that's there, I think, that's as close as we can get from them in terms of admitting maybe last week was a bit of a mistake. They are walking back from that, which is why markets are cooling down a little bit right now.
And Gina, I wanted to ask you about, and Wei afterwards, China's consumer inflation is picking up. There's demands, longer-term demands, or longer-term concerns about, of course, demand. But given we're in a U.S. election cycle, I mean, do you have two scenarios depending on who gets into the White House, Gina, and what happens to U.S. equities?
Yeah, I think that the most important thing is to consider the mix, not just the White House, but also what's going to happen in Congress, because that will be very, very meaningful to determine what happens with the policies toward tax as well as trade. Tax and trade really are the two major levers by which policymakers in Washington, outside of the Fed, can impact equities. And on both counts, both the Republican candidate as well as the Democratic candidate are likely to be somewhat tough on China. I mean, it has not changed materially over the course of the last 4 years. There has still been one big trade impacting the equity markets, and that is the China versus U.S. tech trade. What's happening with that trade has been very persistently underlying a lot of kind of global equity volatility in the semiconductors as well as broader tech space. I don't think that's likely to change. The thing that could change is really trade policy at large. Will we move back into more of a Trump regime that is more tariff related with respect to trades? We noticed in 2018 clearly an elevated degree of volatility in export and import oriented industries related to the trade policies of the Trump administration. So that's something to watch for, certainly. But an even bigger impactor of stocks, frankly, is really what happens with tax. And on this, I think there's a lot of really interesting, compelling opportunities. Both the Trump administration and the Harris administration are likely to pursue policies that are quite different on tax, but they will require commitment from Congress and collaboration with Congress in order to pass some sort of tax policy. And that's really going to be key. So I think that we do want to watch this pretty carefully. Very difficult to price any of this in until the election itself, when we get a sense of not only who's in the White House, but who's in U.S. Congress as well.
And Wei, what's your take, away from this, but also linked to this, on China's economy seems to be battling deflationary pressures. We know about intense price wars. So what does it mean for, again, investment strategy into China?
We have seen today the inflation print coming in a little bit better than expected, but we're still talking about deflationary PPI, right? And that has been plaguing the economy for a while. We have seen the plenum, the State Council, the Politburo came and went. There were some efforts to support the economy. We have seen surprise rate cuts from PBOC, but this is not the bazooka. So structural kind of concern weighing on Chinese longer-term growth, such as aging population, such as the need for reform, they still very much applies. So maybe in response to kind of the near-term effort to support the economy, we see a bit of a tactical bounce, but the longer-term concerns still very much hold, which is why we're neutral China right now.
Wait, are you into the Olympics? I mean, you won 2 Olympic medals at the Olympics in mathematics, right?
In the wrong events, in the not so cool events.
I'm a little bit obsessed with the Olympics. I mean, whoever knew that actually France could play basketball? That was my big takeaway. Gina, Wei, thank you both for joining us. Wei Li from BlackRock and Gina Martin-Adams from Bloomberg Intelligence. Coming up, Kamala Harris and Donald Trump agree a date for their first presidential debate as the two election heavyweights look to land the first blow. That's next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The Democratic nominee.
We're in Atlanta, Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but that's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that, and they're like, oh my gosh, this could actually happen, and I could be a part of it.
Now you can read more of our big take story on swing states online at Bloomberg.com or on your Bloomberg terminal. Now staying with the U.S. election, and Donald Trump and Kamala Harris have agreed to hold their first presidential debate on the 10th of September. Now the two rival candidates will have their first face-to-face clash on ABC News, with Trump confident that he'll hold the upper hand.
She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
Kamala Harris also spoke with reporters about the debates.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
Well, Stephanie Baker now joins us, who's Bloomberg's senior investigations reporter. Also, I would add, with the new book out, so we're counting down the days to that. But so much has happened, I mean, I would say in the last week, actually, since she picked her vice president. How do we assess how it's doing in every state and how their strategies will change, both on the Democratic but also Republican side?
Yeah, the past month has been just a political roller coaster ride filled with twists and turns that no one could have predicted. So I think the next month could, equally have changes that, we're not seeing right now. I think for political junkies, they look at something called the Cook Political Report, which put states like Arizona, Georgia, and Nevada, which were previously leaning towards Trump, into play, saying that they're up for grabs now, which I think shows the kind of momentum that the Harris campaign has managed to get in just 2 weeks. I think there's a lot of energy and enthusiasm with the kind of crowds that Harris is pulling. She's in Arizona today for another rally with Walz, introducing him to another crucial swing state. And I think we'll see how the campaign unfolds, and I think the debate is obviously going to be a huge turning point.
I mean, does the Trump camp do things differently? Are they still on the attack, or will they have to regroup and find a better strategy?
Well, the interesting thing is that Trump had very little planned over the next couple weeks. He's at a rally in Montana, not exactly a swing state. So I think it looks like he's concerned enough about Harris's momentum that he needs to go on the offensive, which is part of the reason why he did finally agree to this debate on September 10th and gave this press conference yesterday. He, is going to be attacking her. He's, threw out these insults, questioning her intelligence and her competence. And I think, he's going to try to land these attacks on her running mate, Walz, as, a liberal lefty, which I think is going to be a hard thing to do, given the way he presents himself as the sort of high school teacher, football coach, all-American Midwesterner.
Stephanie, thank you so much. Stephanie Baker, there, our senior investigations reporter. Up next, more on politics.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself. I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Questioning the Fed's independence, Donald Trump says presidents should have some say over interest rates and monetary policy. He and Kamala Harris agreed to debate September 10th. European stocks higher after encouraging data on U.S. labor markets. Well, that's after the S&P actually notched its biggest rally since November 2022. Plus, the billionaire owner of e-commerce giant Temu becomes China's richest person. So JP Morgan now sees a 35% chance of the U.S. economy tipping into recession by the end of the year, up 10 percentage points. Meanwhile, the Goldman Sachs chief executive, David Solomon, predicts that the U.S. will avoid a recession, and Bank of America's chief economist has said the market is overblowing the risk. Now, let's discuss all of this with Michael Spence, Nobel laureate and, of course, senior advisor at General Atlantic, amongst other titles. Michael, thank you so much for joining us. We had quite a stark awakening this week because of the carry trade. It's nice to have you because of what we're seeing with possibility of a U.S. recession. How would you describe the health of the U.S. economy right now?
I tend to agree with the people, Francine, that fundamentally the American economy is both absolutely and relative to other places really quite healthy. There is some signs of weakness, but basically it's proving to be remarkably resilient, and some of the shocks that are being delivered elsewhere, we're really not very vulnerable, energy and that kind of thing. So I'm fundamentally cautiously optimistic that we'll continue to grow. Now, there are negative factors affecting not just the U.S. economy that, mean that our growth is slower. Productivity growth is not yet rebounded, and that kind of thing. But that doesn't tip you into recession. That just constrains the growth going forward.
Do you worry about the labor market, Michael? I mean, this is one of the biggest concerns. On Friday, we saw a bit of disappointment. This comes on the back of, again, stronger productivity, much stronger U.S. economy. And if the labor market gives, whilst, is that on the back of a significant tightening in a short amount of space, or is it a cycle?
No, I don't think it's a cycle. I mean, I think, this is a kind of high wire act that the central banks are trying to, navigate, right? So there's no question that by raising interest rates and trying to bring them down at a measured pace, they're trying to engineer a kind of controlled reduction in aggregate demand sufficient to take away some of the initial or inflationary pressures that resulted from excess demand. And so far, I think they're, doing a pretty good job in a pretty complex environment. If somehow, that high wire act gets out of balance, then you could see a drop in aggregate demand and some weakness in the labor market. But so far, the movements that we've seen, including, a lower, aggregate new employment figure, last week, or I think it was at the end of last week. I don't think this is a sign that they've kind of missed the mark. The market volatility, I tend to discount. These are not signs that there's some fundamental problem lurking in the near future.
I mean, you did some wonderful research on markets and the labor markets that they gave you a Nobel Prize for it. Are you comfortable that actually the way the market is working or the market function is doing okay right now? Or are there spots in the markets that we should be worried about?
Well, on a slightly longer term time horizon, Francine, there's if it's true, and I'm one of the people who believe it's true, that we're in a period of very rapid structural change, driven by, technology and shifts in the way the global economy works. That means there's a lot of, moving around, job change, different skills and so on. And those things are lurking in the background. And so it's easy to see that we'll get, places where there are labor shortages, places where the skills aren't, the ones that are consistent with what business and the demand side wants and so on. So I don't discount that at all. I mean, this is going to be a pretty turbulent period for the rest of the decade. But on the kind of short run, fundamentals that the central banks deal with, I haven't seen anything yet that's particularly worrying.
I know you've written extensively about the AI economic revolution and how that changes productivity and how that changes also some of our models. Are we underestimating or overestimating how quickly that AI revolution comes?
I would say we're overestimating how quickly it comes. It's a sort of natural tendency that we've seen before. So, that once people realize what the potential is, then there's enormous enthusiasm. It's reflected in investment levels that are just enormous right now, in asset prices and valuations and so on. But history sort of teaches us, I mean, this may occur a little faster than, previous episodes of digital adoption, for example. But the fundamentals are, it takes very big changes in business models, individual behavior, skills, learning, experimentation and all that kind of thing that, so I don't expect AI to produce noticeable shifts in the productivity trajectory of the U.S. economy for a few years yet. I mean, data tends to lag, but I would say end of the decade, if we're not seeing it, then I think the predictions that people like me have made that it has the potential to produce a productivity surge will start to get questioned. Because that's long enough to engineer these changes that are needed.
But Michael, at the same time, we're seeing more and more crises, and it seems that the rate of developing these crises and them lasting is exponentially higher than it was 10, 15 years ago. You actually wrote a book about this with Mohamed El-Erian and Gordon Brown called Permacrisis, a plan to fix a fractured world. Are we dealing with too many crises at the same time?
Well, it would be nice if we didn't have them, but yes, we are. And as a result of that, the global economy is being reconstructed architecturally in a really quite different way. I mean, you can, you at almost every level, business, supply chains, etc. You can see this pattern of diversification. I mean, I just recently learned that the Chinese entrepreneurs are busy diversifying their operations because they're good at what they do in the manufacturing sector into a whole range of other, developing countries where they're hopeful that they can not only achieve, high productivity, high growth, but to some extent, evade the sanctions that and other, fragmentary blockages that are a feature of the global economy now. So it's just it's a different world. It is driving quite a lot of structural change. It's a more complicated world, and it's a riskier one than what we were used to before. But what Gordon and Mohammed and I feel is it's pretty much inevitable. It's hard to see that climate shocks, wars, potential pandemics, and other things are simply just going to vanish in the next little while. So I think what investors and business people are busy adjusting to what amounts to a new reality, for instance.
But is this exacerbated, or is this because of divisive politics? We have the U.S. election coming up, probably the most important in the world. Who's looking at, who's thinking about the right way of fixing the economy?
Well, it's very hard to think of a way to kind of fix the global economy in terms of levels of the cooperation where it really matters. If the political underpinnings are at the domestic level, in wherever, in Europe, in the United States, et cetera, in China, are heading off in a different direction. I mean, from an external, Americans are consumed by the upcoming election, as they should be, but so are, the rest of us. I mean, I think it may, at the risk of stating something obvious, the outcome of that election has material consequences for Europe, for example, in terms of defense, support for NATO, the Ukraine war, and trade and investment flows. So, everybody's kind of holding their breath, I guess is the way I would say it. The bottom line is, I think an absolutely essential ingredient of achieving as best we can reasonable levels of global, cooperation and integration that makes sense is reasonably stable and sensible domestic politics. So that's the hoped for outcome. I'm not choosing sides here. I'm actually delighted that the American election is now in at least a full-blown competition, and that's a good thing for democracy.
Michael, thank you so much for joining us. Michael Spence, Nobel Laureate and Senior Fellow at Stanford's Hoover Institution. We'll have plenty more, of course, with Michael throughout the next couple of weeks. Now, coming up, as the Paris Olympics comes to an end this weekend, the games are almost over, but some companies are using AI to keep the flame alive. We discuss all of this with Amazon Web Services Managing Director for EMEA. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
After 2 weeks of grit, determination, and sporting excellence, the Paris Olympics comes to an end this weekend. Now, as sport and fitness continues to play a bigger role in our daily lives, some companies are looking to use AI to advance it further. Now, one of those companies is Amazon Web Services. We're now joined by Tanuja Duranderi, the Managing Director and Vice President for EMEA. Tanuja, thank you so much for joining us. Everyone was kind of glued to the screens to try and understand the longer. It feels very wholesome, actually, to look at some of these Olympians trying to compete for gold. How do you think you've changed the way that sports is seen across the world?
Well, it's just wonderful to be joining you here, Francine. So thank you for having me. And isn't it just the most exciting time at this sort of grand dam of sports, let's say? But sports is a really interesting vehicle to showcase the power of data. Every sports person, whether you're a cyclist or a swimmer or a gymnast, there's just an enormous amount of data that they're generating. As an example, in the Bundesliga match, for example, 3.6 million data points gets generated every match. And what we do is we take that data, we collect and analyze it, and then we apply a number of AI machine learning insights to it. So the sports teams, whether you're a team, an athlete, a coach, are getting the most out of that data to be able to improve performance, to be able to worry about health and safety, and of course, very importantly for us, the fan engagement aspect as well. So I'll give you one example, because we're in the middle of the Olympics. The national swimming team of Australia, we've been working very closely with their coaches, taking their training footage, applying machine learning and insights to that, giving that back to the coaches, and they're able to really get their team combinations in a way that allows them to really go for gold. And in the Tokyo Olympics, they won 9 goals as a result, and here they're actually doing very well as well. So they're really getting their performance improvement out of the understanding of that data and the insights generated.
I mean, Tanuja, I imagine this is like at all levels, right? You have to, first of all, recruit a young kid that's going to perform extraordinary. Once you have that young kid, it's about making sure that you coach him or her in the right way. And then it's also looking at the opponents. If you break it down, where is this analysis more useful? Do you have data on that?
Yeah, it's actually in all, I would say it's across the life cycle. Because, I mean, of course, you have to start with human performance at the end of the day. But what data is doing is allowing these coaches to really help those athletes understand where they're good, where they need to develop further by combining the historical data they've got with the real-time data and then feeding insights back. So, I'll give you another very good example in motorsports, for example. Every one of those F1 cars, as an example, has, 300 sensors during a match, right? During a race. During that race, you get 1.1 million data points coming off the pit and coming off the cars into the pits. The teams are looking at that data. They're feeding it back in terms of providing drivers a view of what they should do. So should you overtake? Should you pause? Should you come back into the pit? Should you change your tires? So you have action during the race, action before, and then afterwards, post-analysis on really looking at how you can further improve. So it's really the whole life cycle that the data and insight gets used.
I mean, there are a number of also gold medalists who actually did much better than the record currently. How much has that helped by data analysis and helping them and actually achieve better? I mean, some of the things that we see on TV, you just can't believe that are humans doing that.
Yeah. Well, humans do perform incredibly, really, especially under that moment of stress. And, it is so much training that goes into making these athletes amazing. But, when the difference between silver and gold, milliseconds matter. And it's during that time that the data and insight is probably at its most powerful, right? So again, back to that swimming team example I was giving you earlier, what they're able to do is say, right, this combination of relay teams is going to be better than this combination of relay teams. They're able to track trajectories in terms of what the ending point will be for those swimmers in the race. They're able to look at competitive combinations. And then when they put that together, you get magic, right? So it really is a combination of, as you said, human performance and the data, but not data alone, because data alone is not very useful. It's the AI and machine learning applied to that data that gives you all of that knowledge and experience to draw insights.
I mean, is it also changing the way we look at and see and how Formula One is driven?
Well, I tell you, fan engagement is a very interesting angle, Francine, to talk about, because fans are really, really hungry for this data. They don't want to just be on the scene, as they say. They want to be behind the scenes. They want to understand what's the strategy that's being applied, right? How should I think about driver A versus driver B? By the way, we've been working very closely with F1 as well to really redesign the cars. Overtaking is a big thing, and so really redesigning the cars to help with the overtake patterns, for example, using high-performance computing. But I'll give you a really good one. We developed this thing called F1 Insights with F1, using, by the way, 70 years of their historical data, combining that with our real-time data. And those F1 Insights are then fed back to fans. So one of the ones I really like is who's the fastest driver? And everyone has their own view on who's the fastest driver through history. And with the F1 Insights, we were able to show actually that it's always been Senna who has been the fastest driver. But when you ask people that question, they come back with just different answers. But that's one of those examples. It's all about, speed, overtake. Are you too close to the edge? And it's very powerful for F1, for the teams, as well as actually the drivers themselves.
Tanuja, I know it's been also like a tough week for tech stocks and AI in general. We're not going to get onto it now. But do you think we're underestimating how much AI is also transforming some of the entertainment, some of the things that we like on doing? Do you feel like it often gets a bad rep?
Well, I tell you, I really feel, and we're very convicted about this, this is a transformative technology. It's probably more transformative, Francine, than the cloud when it was introduced, and probably even the internet, I would say. And the reason it's transformative is it can actually augment or accelerate or automate pretty much any process in any sector. We've done some recent research, by the way. It's our Unlocking Ambitions report. We've seen an uptake in the increase of AI by European businesses by 30%. And when you look at that and convert that to what would that mean for the economy, you're talking about the potential of 600 billion euros of economic value that could be unlocked as a result of AI. But as I heard your previous guest on the show, it isn't just about the AI. What we need to do is make sure that there's choice and availability of models, for example. We do that through our Amazon Bedrock platform. We need to make sure it's secure. There's enterprise-grade security. People know where their data is. They know it's secure. And then we need to make sure we build confidence by having responsibility around the AI. And we're very committed to this, by the way, by introducing things like guardrails, where it actually removes harmful content up to 85%. Making sure that we're removing biases from the data that people are working on in these programs. So it's really, really important that those three things are there. But I think the other important thing is skills. The lack of digital skills is probably the biggest issue and obstacle that we see, not the technology, not the infrastructure. And we're super committed to also making sure we train millions of people around the world. Actually, we've trained 31 million people for free around the world.
Tanuja, thank you so much. We'll have to get you back on to dig a little bit deeper into that. Tanuja Randeri, the Managing Director and Vice President for EMEA for Amazon Web Services. Now, coming up, we'll look at how a former Google engineer has become the richest person in China. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The tech tycoon and founder of e-commerce giant Temu has become China's richest person. Now, he replaces Zhang Shangshan, the country's bottled water king, who held the top spot since April 2021. Now, joining us now to discuss all of this is Bloomberg's Charlie Wells. Charlie, this is exciting. I mean, for him, but also for us because we get to cover the story. Who's Colin Huang?
You know, he kind of represents a new generation of billionaire in China, and one who's, you know, quite different from Jack Ma, who I think is a very household name for people. He's younger, he's 44, but he really had that kind of global experience that a lot of older billionaires didn't have. He got a degree from the University of Wisconsin and then helped helped start Google in China.
So what do we know about Temu? I mean, well, all I know is every time I'm on Google or another search engine, it always comes up for anything I'm looking for.
So much advertising, and I kind of bill it as the sort of cheaper Amazon.com. So, you know, owned by PDD, it really got its international blow up in 2022 and sort of has been the app of the moment because it sells cheaper products to people from the internet.
He's 44 years old. Do the good times continue for Temu and him?
It's difficult, right? Because there are these tensions between the West and China ramping up. It's going to be sort of a punching bag. And I think a lot of the questions that people in China and outside have been asking is, how is this stuff so cheap? And there could be legislative changes surrounding that.
Okay, but we've definitely asked for an interview. So
Good.
let's see.
It would be a good one.
It would be an amazing interview. Charlie, thank you so much. Charlie Wells there with the newest, of course, richest person in China. Up next, a Bloomberg Brief with Manus Karani in New York, and this is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Good morning from our global headquarters in New York. I'm Manus Granny. You're welcome to Bloomberg Brief. Let's set your agenda. Losing velocity, the global stock rally continues following the biggest single-day jump since 2022. Chinese inflation picks up. CPI unexpectedly rises in July, but weak domestic demand remains a concern. And Vice President Harris and Tim Walz continue their swing state tour. We speak to Lindy Lee, member of the Harris National Finance Committee. Good morning to you. You've just had one of the big turnarounds since November 2022 in the equity markets. We are up this morning, but there's a fundamental question you need to ask yourself as you wait for the CPI and the retail figures next week, as to whether the carry trade is really completely unwound. And this is the perilous question you need to ask yourself when we're trading dollar yen at 147. I like what Carly Garner said to me yesterday. We had an uncivilized rally, and this is a level of uncivilized complacency. As far as equities are concerned, UBS say, look, solid growth with rate cuts can give you 17% upside. By the way, Bank of America say sell the first rate cut. I mean, take your choice in terms of who you actually follow. But wow, what a turnaround in these bonds. I mean, in the space of 6 days, this time last week, we were pretty much at this level. We dropped to 366. We've turned it around. And the auction yesterday was, as Nat Alliance say, another lousy auction. The 30-year auction tailed. So there's a little bit of indigestion in these bond markets. It's going to be a bumpy road, according to Dan Iverson, and a harder landing probability rising to 25 from 25 to 30%. But you need to ask yourself what happens with yen. Is BNY right? You're too bearish? Still too bearish on the yen. We can get to 100. It's their fair value. And that, you know, the carry trade. JP Morgan say 3/4 of the carry trade is done. Citi say we're out of the danger zone with the carry trade. Speaking to people on the IB this morning, they are also saying in the cash FX market, and this is important, in the cash FX market, probably 3/4 of that is done. That's in conversation with various guests on the IB. Well, we also have had another piece of data this morning to China. The consumer prices rose more than expected in July, but concern about domestic demand remains writ large. Let's talk through these numbers. Tom McKenzie is with us. Tom, you spend a lot of time in China, so digging through this data should be a walk in the park for you. Top line versus the core. It's important that we draw this distinction and what the drivers were.
Yeah, that distinction is really important, Manus, because top line, the numbers came in for consumer prices, an increase of 0.5%, 0.5% in the month of July, as you said, above the estimates. But you lift up the hood and you realize that there are weather effects that pushed up the prices of things like vegetables. There was a very low base when it comes to that key input into the consumer price basket of China, which is pork prices. Very low base last year. So you can strip that out as well. And what you see at the core level is that actually prices are very soft. Prices actually came down for the likes of autos, for the likes of cars, smartphones, and appliances as well. There's a massive price war going on in China, and consumers are sitting out to see if prices continue to fall. The consumer and that demand picture remains very soft in China. On producer prices, you're almost at a 2-year stretch where producer prices are in deflationary territory in China, and that talks to a key concern, exports are not kicking in. We saw that in the data out of July. Exports were soft, so they need the consumer to come to the fore if they're going to hit that 5% growth target. And that's why you have a number of economists saying there will need to be more measures from policymakers in Beijing, including a rate cut. They've outlined, senior leaders there, a 20-step plan to boost the consumer, but it was lacking in detail. That was the take from many, and it didn't come with additional fiscal support. Economists are saying more will need to be done to get that consumer back and to get those consumer prices up.
It's interesting, and we've got this angst over the policy response mechanism. You've got the yen unwinding. That could have a reverberation back on the yuan. You've got the Aussies talking about a pretty hawkish narrative in terms of what they're prepared to do with rates. Tom, this angst, we've seen some policy response mechanism from the PBOC this year. Some would say it's been incremental, too small, piecemeal, and not enough for the consumers. So where is the debate on the policy response in China?
It's really shifted from the need to stimulate at a central bank and monetary policy level, and as you say, they have done that, to the need to get cash into the pockets of consumers. And you've had, really interestingly, prominent economists, prominent voices in China putting their heads out above the parapet and saying it's time to get cash into the pockets of consumers. So far, though, senior leadership appears to be reluctant to do that. We do expect, the team at Bloomberg Economics expects another rate cut from the PBOC and maybe a move lower in terms of reserve ratios for the banks. We'll wait to see if they do anything more material on the consumer side.
Tom, thank you so much. Tom McKenzie there on the very latest data from China. Well, it's been a hugely volatile week for the bond markets and cross assets as the carry trade unwinds. Joining me now is Alex Stewart, Global Unconstrained Fixed Income Fund Manager over at Schroders. Good to have you with us. The debate is this, is to what extent this carry trade has been unwound. Alex, when we look at the responses, and some would say hysteria in the bond market, 366 on the downside is where we went on the 10-year government bond yields. We're back at 390. We're back almost at that 4% level. Give me your take in the level of volatility. Have we seen the worst? Is the worst passed from the carry trade? Do we move the narrative on now?
I'm not sure that that's exactly the case. I think things have got a little bit ahead of themselves in terms of fears of recession and I don't think that actually what has happened recently has changed an awful lot. Obviously, with the Bank of Japan raising rates, that has caused a bit of an unwind, but I don't think that we are actually heading for a recession and that the worst fears will be realized.
I mean, when you look at the flow in the bond market, as I say, we crashed to 366, talk of an inter-Fed cut, 50 basis point cut. Let's just listen to the Richmond Fed President, Tom Barkin. He spoke yesterday about the central bank's path forward.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, in a steady, deliberate way, normalize rates, and stick the landing, if I could use another balance beam analogy. Or, is this one where you really do have to lean into it?
So that is the debate, how much time they have and what they do. If I look back at Bill Dudley just 10 days ago saying, look, he's pivoted from being from a hawk to a dove. Listening to Barkin, we have time, but will the market afford them time? Do they need to do a precautionary 25 basis point cut in September to avoid a harder landing?
I mean, that is the question. To be honest, I don't think that the data is bad enough and that they really need to panic at this juncture. I mean, I think, I think we've got very used to the fact that the Fed put was there previously for, stock market wobbles. But I think that, they'll be going to be quite cautious about signaling that. And they'll be, doing as they've been saying and keeping an eye on the data. And it's probably quite, balanced as to whether they need to go just now. I think they will be a little bit cautious about trying to signal that they're panicking in any way.
And if you look at bonds, it's interesting, the conversations I've had this week has been, the 60-40 portfolio behaved pretty well. Bond markets pretty much took the lean as a hedge. And I just wonder at what level you say to yourself, look, there's been quite a significant rebound in 10-year government bond yields. I know Dan Everson over at PIMCO says it's going to be a bumpy road, but he would be prepared to add in 10s at 4%. They just look a little less attractive than they were. From a duration point of view, how does duration look to you?
I mean, I think we got a little bit overdone. If you look at where we got to on Monday, it was very much, you know, emergency rate cuts were being priced in. It was very hard to see at that juncture, you know, how much more they could be expected to do. I think there was a little bit of a panic. We are in summer markets. We can get the volatility can push things a little bit too far. I mean, we've retraced a little bit from there. And possibly could do a little bit more. I mean, I think longer term, obviously, we are about to be starting a rate cutting cycle. So, you know, duration is not unattractive, but I just think we got to a point where there was just too much priced in.
Yeah, I mean, there was a certain hysteria to this market. Now, in the past 24 hours, politics is never far from the agenda on Bloomberg Brief, and the former President Trump spoke at a press conference yesterday and whether a president should have a say in, you got it, monetary policy.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Now, to your average bond investor or bond manager, that possibly strikes fear. If there was ever an example of a toxic combination between politics and monetary policy, it was this week in Japan. Hiking rates, some would say, you know, the Bank of Japan learned a salutary lesson from the politicians. When you hear that from Donald Trump, how do you think bond investors would react to that concept?
Yeah, I mean, it's a little bit concerning. I think, you know, there has been a little bit of maybe, you know, we saw it in the UK not that long ago that, you know, that politicians quite often just assume the bond markets will be there to fund whatever. And actually, you know, we have to see that inflation is going to be under control and that we are on a steady course. So, yeah, I think there would be some concerns about that.
Yep, it certainly would bring into question that that unique position that U.S. Treasuries have in the world. Alex, thank you very much. Alex Stewart there over at Schroders. There are other stories trending on your Bloomberg terminal this Friday morning. If you're still with us, the UK is weighing steps to tighten rules for online platforms such as X. This comes after days of rioting in the UK. Prime Minister Keir Starmer called for a mature conversation with social media companies to limit malicious content. Donald Trump looked to recapture attention and momentum in his race against the VP. Kamala Harris dangling a series of debates and fielding reporter questions for over an hour at the Mar-a-Lago resort on Thursday. Their first debate is expected to take place on September the 10th on ABC. An earthquake near the coast of one of Japan's southern islands has prompted the government to issue its first ever warning of a megaquake. The country's prime minister called off a planned trip out of caution. Bullet trains ran at reduced speed and some chip-related factories temporarily halted their production. Coming up, Taiwan Semiconductors sees a 45% revenue spike in July. We'll take a look at what that says about the AI demand structure right here on Bloomberg. Good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Take a little bit deeper into these markets and equity markets specifically. It's been a wild week. Joining me now is Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist. I mean, Gina, if you just look at the VIX through the week, parabolic moves on the upside, a little bit of temperance. The S&P never quite made it into correction, but the NASDAQ took a much more aggressive dip. When you stand back 6 days later from the jobs report, how do you contextualize what we've just seen?
Yeah, it's been a wild ride for sure, but when we really think about what's happened in stocks, you can date it all the way back to the turning point at the middle of July, which was really sparked by a change in the yen, which led to the change in Bank of Japan policy, which is a generational shift. We're contending with the first hike in interest rates in Japan in 17 years. That sparked a bit of volatility that was then exacerbated by the bond market's anticipation of U.S. economic data, or interpretation of U.S. economic data as imminently likely to create a major Fed easing cycle. That divergence in policy rates has created this carry trade unwind. And remember, that carry trade had been building up over nearly 2 decades in time. So we did have this vicious response in equities over the weekend. I do think that the Bank of Japan's statements that they're unlikely to continue hiking as long as volatility in financial markets is in play really created the stability. But that, along with some rationalization in the bond market regarding an interpretation of the economic data, through the course of this week, the economic data has come in pretty stable. So I do think we have that sort of right sizing of expectations going on, and that's definitely fed through to equities. You know, the most liquid stocks in the world, of course, being the biggest of the big cap stocks in the U.S., really have taken it on the chin, along with the Japanese equity market. So I think that that's a lot of what's going on and what's at play here in the coming weeks. We've got to watch the Fed and the Bank of Japan probably as our most key indicators.
I mean, I like what Mark Cudmore said on the M Live chat. It's the market, not the economy, that is structurally problematic. And that's true, but that plays back to your point, which is in these vortexes of where we deleverage and see risk off, you go to the most liquid assets, first of all, to divest those. Obviously, ground zero is Mag 7, large tech, big tech. But you look at the valuations after all of this angst, and you look at the sector overall, I know that, and on a PE basis, it's trading just below we were at the highs of the pandemic. But can you split that out for me for the group versus, let's say, Mag 7? Has there been a significant revaluation in the PE for Mag 7?
Yeah, unfortunately, no. This is still a group that's incredibly excessively overvalued. Now, stock by stock, I think it's important to look at the Mag 7 stock by stock too. But when you look at the group as a whole, we're looking at still near record level valuation spreads, in particular compared to the S&P 500. And that, I think, is really important. It's the spread that is probably most indicative of the excess optimism in this space. It's also what's created the sort of impossible expectations that these stocks have faced throughout this earnings season. But that spread does suggest that while we've piled all of our hopes and dreams into the Mag 7, The rest of the S&P 500 has very, very low expectations implied in valuations, at least by comparison. And that does open an opportunity for investment. As we start to see some clawback of earnings progress in the rest of the index, the 493 stocks that are not Mag 7 stocks, we should start to see capital flows improve for those companies. We should start to see some stabilization and maybe some right-sizing of valuations in that group as well to catch up. Now, I think at the same time, you've got to consider how the Mag 7 can grow into their multiples. Historically, what's happened when multiple spreads have gotten so high is Mag 7 prices simply stop rising as fast as earnings. And we could see earnings produce a bit of catch-up, allowing for those multiples to normalize. I think your natural proclivity is to worry that prices have to decline in order for multiples to normalize. I just want to put out there that multiples can normalize in more ways than one. You can see earnings catch up to price, and that may be a period of time that we're moving into now.
Gina, let's see whether we get a little bit more volatility. We've got CPI, we've got retail sales next week. So again, we're living day by day on this data in terms of the emotional response by these markets. Gina, thank you very much. Gina Martin-Adams of Bloomberg Intelligence, wrapping up a week of huge volatility in equity markets across assets. Coming up on the show, we'll take a look at the other headlines around the world on the papers and the sources that we check, including President Biden's efforts to break the deadlock on the ceasefire talks in Gaza. Context matters on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Friday edition of Bloomberg Brief. I'm Manus Granny in New York. Front pages, this is what we've got for you. Headlines from around the world. First up, the Journal leads with Biden's move to break the Gaza talks deadlock. The US, Egypt, Qatar are making a last-ditch proposal to reach a ceasefire agreement with Gaza. Leaders from both Israel and Hamas are urged to meet on August the 15th for negotiations. Of course, a lot of this is going to come down to the response that we see from Iran onto Israel. Still waiting, the world is still waiting for that response. What impact will that have on those discussions? Next up, New York Times, Ukraine's push into Russia. It's surprising turn in the war. The Ukrainian forces are advancing several miles across the Russian border into the Kursk region. Now, the attack caught Moscow off guard and opened up a new front in the 30-month war. TSMC's revenue rose by 45% in July, accelerating its pace of growth. This provides optimism that the AI chip demand remains strong. Let's dig into those numbers. Peter Elstrom is with us to go through these numbers. So, Peter, look, 1 month, a nice set of numbers for TSMC. What's the first read on that, on the broader picture?
Well, it's a very good point. This is just 1 month of sales that we got from TSMC. Taiwanese companies report these monthly sales, which can be indicative of what's going on more broadly. I think after the big scare that we got in the market earlier this week with the Monday troubles in the stock market, everybody wants to see the next sign of where exactly this is all going. And TSMC is a very good indication of what's happening in the semiconductor industry. So this is an indication, the 45% bounce that they got in sales in July is an indication that maybe they're going to surpass the expectations for the third quarter. Those are about 37% right now. TSMC makes the chips for NVIDIA, for AMD, and also for Apple. So it begins to give you a sense that demand from those customers is pretty strong for TSMC right now. Now, is that enough to kind of prove that the AI trade is back on, that things are positive? It's only one data point at this point, but it is a positive data point, and I think that's giving some investors some reassurances that people are still buying these chips.
Look, they have a dominant position, there's no doubt about it, in this marketplace in terms of their ability to price and in terms of the flow of business. Do you think that out of one, I don't necessarily know that out of 1 month's data you can extrapolate overall AI demand. The issue is more about monetization of AI capex, but from the demand side, what do you think this can tell us?
Yeah, that's a very, very good point. These are the suppliers of the equipment to the big companies that are making these massive investments in AI services. So the customers for NVIDIA and for TSMC by extension are the Microsofts, Metas, Amazon, and Alphabet. They're the one making these multi-billion-dollar investments in AI services. And what we don't know yet is whether those services are going to pay off. Gotcha. We know that they're buying a lot of chips. They're buying a lot of chips from NVIDIA and TSMC, but where's the revenue on the other side?
Okay, Peter, thank you very much. Wrapping up the TSMC numbers, one swallow does not make a summer. Peter Elstrom there with the very latest. We'll take you through what's going on with the oil markets, and also we're going to catch up with Lindy Lee.
I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
From our global headquarters in New York, it is Bloomberg Brief. I'm Menace Cranny. Time to set your agenda. Losing velocity, the global stock rally stalls as markets question a renewed push of the carry trade unwind. Chinese inflation picks up. CPI unexpectedly rises in July, but weak domestic demand remains a concern. And Vice President Harris and Tim Walz continue their swing state tour. We speak to Lindy Lee, member of the Harris National Finance Committee. A very good morning to you. To what extent are these equity markets reflecting on the scale of the unwind and the carry trade? Either way, we managed to put on one of the best days performance since November 2022 on the back of one small piece of data. No serious injury from the jobless claims. Is that enough? We look forward to CPI and retail sales next week. We're up by 0.3%. TSMC's helping the tech and the chip side of the business. But UBS make the point, look, if you've got reasonably solid growth, i.e. a Goldilocks kind of scenario, and rate cuts, they actually see 17% upside in these equity markets. If anything, this vicious and pernicious volatility that you have had this week is indeed for them a contrarian signal. Then the other side of the trade is Bank of America say sell the first rate cut. You know, you can take your choice. The market has certainly repriced the capacity of rate cuts. We've whipped it around from 366 on the downside to call it 4% for cash on bonds at 395 at the moment. Yields dropped by 2 basis points this morning. Again, the narrative is this: you no longer need an inter-Fed cut, nor do you need 50 basis points, but do you need an insurance cut of 25 basis points? Also on the bond auction yesterday, it was another tough sell. Nat Alliance called it another lousy auction, and Dan Iverson says you're going to have a bumpy ride in these bond markets, but he would add duration at around the 4% level. It's just not as attractive as it was. You just need to debate whether the carry trade is really undone. Citi say the worst of it's done. JP Morgan say the worst of it is done, and I've just had an IB from Kit Duke saying he feels that 3/4 of this, if not more, of the unwind has been done. But, you know, fool me once and all that jazz. So that's the state of play on markets. Nvidia's up 2.25%. Still, it's had a pretty tortured tour from the very top to the bottom. The Nasdaq obviously making it through and into a reasonable level of correction. The S&P 500 never quite made it through the correction. Okay, we are less than 100 days away from the US election. Donald Trump has agreed to debate the Vice President, Kamala Harris. Meantime, Harris and her running mate, Tim Walz, continue their swing state blitz. Here's what they said on their tour.
We got some work to do. We need to move to the general election and win that. And to all the friends, listen, we also need to level set. We are the underdogs in this race.
We want to recognize the right all people have to freedom and liberty to make choices, especially those that are about heart and home, and not have their government telling them what to do.
Donald Trump's not fighting for you or your family. He never sat at that kitchen table like the one I grew up at, wondering how we were going to pay the bills. He sat at his country club in Mar-a-Lago, wondering how he can cut taxes for his rich friends.
I know exactly what we are up against.
Joining me now is Lindy Lee, member of the Harris National Finance Committee. Great to have you with us. Timely to have you here.
So nice to be here. Thank you so much.
Good to see you. I mean, some people are saying this is almost like Clinton Gore, this team up, the response in the halls, the kind of momentum that they have delivered. How strongly are they cutting through as a team, as a combo?
Oh my goodness, they've been a powerhouse together. The blue wall is back in play. Michigan, Wisconsin, and Pennsylvania, my own state. Harris is leading in all three. It's just been absolutely phenomenal. She raised $310 million in the month of July, and it wasn't even the month of July. It was the final 2 weeks of July. So this is just mind-boggling, and we are absolutely thrilled. I was lucky enough to be at the first rally in Philadelphia. She invited me to the VIP reception. It was just, and watching them both, Walz and Harris, they have incredible energy together, and he is very down to earth and makes people feel comfortable. He's exactly the kind of person we need on the ticket.
Well, they're certainly selling, you know, the folksy teacher, military side of him. Now, you say Pennsylvania is leaning towards Harris, but we've done our own polling here that shows Trump is up 4. Yes, she has cut into his lead, but it's not leaning to Harris. So what do you see? Where are you seeing that? What exactly are you seeing when you say it's leaning to Harris?
I'm seeing the young people who are finally galvanized, the young people who are sitting on the sidelines, the 30% who weren't happy about Biden being at the head of the ticket. Now it's overwhelmingly, Democrats are overwhelmingly thrilled to have Harris at the top of the ticket. I haven't seen this energy since 2008 when I was a kid supporting Senator Obama. She's completely upended the landscape. Georgia is back in play, for goodness sake. So she's completely upended the math. She has many paths towards 270, and this is the right thing for the party.
But can she get that path to 270 without Pennsylvania? Because Shapiro's off the ticket. So I suppose the question is, without him on the ticket, can she win Pennsylvania?
I think people need to remember that he doesn't need to be on the ticket to be an effective surrogate. He's going to be out there. He's committed. On Tuesday, he even said himself, he's going to be out there every single day making the case, prosecuting the case, litigating the case against his convicted felon who faced 88 criminal charges, 4 indictments, 2 impeachments. You all know that 26.
Yeah, we've got. Listen, yeah. we've got the laundry list of you know, felonies, etc. I suppose what we want to know from our perspective is, what's her policy that's going to work in Pennsylvania? It's a huge energy state. She was against fracking. She sort of railed against that. Now, when's she going to come out and make a very clear statement on energy and fracking? Because she hasn't done any interviews yet.
Well, she kind of did one on the tarmac today. I know she's going to do one more extensive one later in the month. She already spoke with her staff, and she committed to doing one. And they're also going to debate on September 10th. One thing I do want to mention is she did say she's no longer in favor of the fracking ban. So she's making concessions, and she's also going to make sure that people know she's the rule of law candidate. Do you want stability in the markets? Do you want to prevent a free fall in the stock market? Do you want rule of law? Do you want to enshrine, revere the Constitution? Then Kamala Harris is your candidate, not the convicted felon. How do businesses prosper when there's a tumultuous environment?
Well, I think we should, look, I understand all those statements, and both sides make the same kind of thing. You know, do you want a strong stock market? Do you want a stock market that crashes? You know, I think what people want is fiscal responsibility in the first instance, rather than hyperbole about whether you want a higher stock market. I mean, the jobs market is strong at the moment. Unemployment has risen ever so slightly. Growth is solid in the United States of America. There's no talk about a parabolic drop in the equity market if Trump came to power. Let's talk about the money. The campaign's doing well. You've said that, the scale of the money that has been raised. I'm just wondering, is Walz, is he carrying through? Is he hitting through in terms of raising his own money? Any numbers there that you can give us?
So I'm one of Harris's biggest donors. I sit on her National Finance Committee. I raised $1.1 for Biden over a course of a year. I raised $2 million over a course of 5 days a week, essentially. So the comparison is just mind-boggling. And with Biden, I had to do a lot of sweet talk, you know, a lot of like finagling kind of thing. But with Harris, people are just like forking it over. They're so eager to get on board.
Who's the biggest donor so far? Who's the biggest ticket that you raised for since
well, I don't want to...
Oh, break news. Feel free.
Well, I don't want to divulge confidences, but you will find out eventually on the FEC report. But this is someone who's able to write 920, what was that?
So it's one ticket, it's one check for how much?
One check for the maximum $929,600, I think is the limit, because they have a joint fundraising agreement with all the states. That's what that allows them to donate more than the $3,300 stipulated by the FEC.
So the one thing that we saw with Harris on the money side, which was invigorating people who've never donated before, perhaps who haven't been politically active before. 66% of the money that she raised was from new donors. What can you tell us about the flow of money, these new numbers that you're talking about in terms of new donors?
I'm seeing it myself. I'm actually leading a fundraiser called Christians for Harris. I'm a Christian, and that's on Monday. We had small dollar donations just pouring in, and these are like $50, $20 even. $100. These are not big ticket donations, but accumulation of many of these small contributions, it's an avalanche. It's just phenomenal. I've never seen anything like this before.
Which social media platform is doing the best for you in terms of raising the money?
Twitter. Twitter's one, and then TikTok, because she's winning the meme game. I don't know if you've been noticing.
Yeah, no, we've got that.
Exactly.
Yeah, Kamala is bad. What sort of ads are you going to buy with the money?
3 words: Pennsylvania, Pennsylvania, Pennsylvania. As you mentioned just a few moments ago, Pennsylvania is the ball game. If we win Pennsylvania, she has the White House. So both campaigns, actually, both Trump and Harris have committed to spend hundreds of millions of dollars in the state. I'm actually a commissioner in this Commonwealth, so I have my finger on the pulse of the situation. And I have never seen young people, and women in particular, so excited about this ticket. Because Trump is the candidate who overturned, he's the one who appointed the 3 justices who overturned Roe v. Wade, and that's something that we will never let him forget.
So by the very nature of what you just said is Pennsylvania, 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 Pennsylvania is, if you don't win Pennsylvania, there's no road to the White House.
There's no road. It's going to be very difficult. We need Pennsylvania. We need Pennsylvania. We need Georgia. If she has both, we win.
Okay. We wish you well on the campaign trail and with raising more funds. Well done on the efforts so far. That is my guest this morning, which is Lindy Lee of the Harris National Finance Committee. Coming up in the show, we'll dig into the crude markets and check in on the developments on what Bob McNally thinks about the Middle East.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny in New York. So oil is poised for a weekly gain after a string of losses as traders continue to watch developments in the Middle East. Rapid Energy founder Bob McNally says this of the market: oil fundamentals are broadly neutral. Crude prices are struggling against a macroeconomic pessimism, punctuated by sporadic and brief geopolitical mini spikes. Now, while we expect Iran will pull its punches to avoid a regional war, the market remains too complacent. Bob joins me now. Bob, you have joined me on several occasions when we have been in anxious periods of waiting to see what the Iran response mechanism is to Israel, and obviously their moves on Hamas and Hezbollah. We don't know what that response mechanism is at the moment. The calibration, your assessment of what calibrated response might be.
Good morning, Manus. So our base case is that Iran must thread the needle and will respond to the recent eliminations in Tehran and Beirut by Israel with a retaliation that is sort of strong enough to sort of try to dissuade Israel from continuing those attacks, but not so strong that it triggers a regional war. And they'll do it unlike April, which was just an Iranian attack on Israel. This time it's probably going to involve, even feature its allies, Hezbollah in Lebanon and Syria and Iraq, and maybe the Houthis as well. So more of a broader front. But it's a Goldilocks type of revenge they're looking for. Not too hot, not too cold. And then, Manus, there is the chance that there will be a breakthrough on the peace front. In other words, Biden administration right now is scrambling to say, look, call off the retaliation. Let's get a deal in Gaza. So those efforts are underway. But we think base case is Iran and its allies will retaliate here.
Would a multi-pronged retaliation, as you say, via the proxies not be something more significant than the three, in April time it was 300 projectiles, 170 drones, 120 ballistic missiles. What you're framing to me sounds more substantive than that, or just clarify.
It depends. So Hezbollah in Lebanon, with its inventory of missiles, actually poses a bigger threat to Israelis than Iran. So it depends on what Hezbollah does. Manus, I think the most important metric to watch, God forbid, is whether there are Israeli fatalities. In April, no one died.
Yeah.
Look what happened when the Houthis killed one Israeli in Tel Aviv with a drone. The Israelis lit up the port of Hodeidah and killed several people. So Israel is in sort of a 3 eyes for 1 eye, not eye for eye, 3 for 1. So it all depends on whether Hezbollah and Iran cause fatalities in Israel. That'll determine whether we leg up in terms of geopolitical risk in crude, I believe.
Which then takes us to the response mechanism. We're just showing the price of crude at the moment up 3.74% on the week. But I look back on the chart here. Obviously, it's been really brutally taken down by the macroeconomic de-risking concerns. Here we are. We're back to reassessing war and geopolitical risk. When you look at the demand side of the equation and the war side of the equation, are we at sort of a cap here in terms of the market, because the demand side will ultimately pull us back?
You know, I think both on the demand and the supply side and the fundamentals, oil is sort of trading sideways. I mean, across different products and across regions, you can find pockets of strength. U.S. gasoline, even total oil demand in May, blockbuster strong. India, soaring. China, weak. Jet fuel is white hot globally. Gasoline, firm. Distillate, the economic fuel, weak everywhere, especially in Asia. And if you look at differentials and spreads and physical trades in Europe, Brent is starting to show some life. So as we look across the complex and we analyze the data, you can be a bull, you can be a bear. It's sort of neutral here. It's signs of stock draws.
Okay.
But the market, as you said, is not trading off of this. The market is trading off of macro, Bank of Japan, Federal Reserve, and geopolitical risk occasionally.
Let's take the optimistic side that Iran threads the needle, no massive escalation or injury. I mean, these are all very, very, very optimistic scenario plans. But let's say the response mechanism, and that there is a geopolitical de-risk, a coalescing of the minds on August the 15th. My question to you would be then, progress on a ceasefire, put that to one side. With, as you say, macro worries and China's lethargic demand, can OPEC Plus actually continue to add the barrels back on the program that they've outlined?
Not without accepting lower prices. I think as we sit here today, OPEC Plus leadership still intends to launch the tapering. It's scheduled in October. But that's, 180,000 barrels a day per month. It's not too much. We don't expect much in terms of these compensation cuts. If you believe Iraq is going to comply with its compensation cuts, OPEC Plus supply is going down later this year, not up. But it's unlikely Iraq will comply. More likely, they will launch it, Manus, but it's going to be a week-to-week, month-to-month sort of monitoring of the conditions. I believe Saudi Arabia, UAE, Russia, they are able and willing to pause that tapering if they see fundamentals weakening. But right now, they're sort of looking through this macro noise and this short-term volatility in crude prices, and they believe fundamentals are starting to move their way.
Tell me this, Bob, you've advised at the White House in various administrations gone by. Here we are. Politics is never far from the oil market or from the White House. Kamala Harris has done a volte-face from wanting to ban fracking. Obviously, it's very important in Pennsylvania, to something different. We need clarity on exactly what that is. How do you see U.S. oil policy under a Harris presidency?
Under a Harris presidency, really, no president can really do much to unleash production in terms of increasing crude production. The industry operates it all out. We don't have spare capacity. However, a president has the power, Manus, to hurt oil production and gasoline and refinery output. So with Kamala Harris, she says she no longer supports banning fracking. Were she to try to do that, she'd need Congress, unlikely to happen. However, and we've talked about this in the past, the president has a pen and the authority to restrict or ban exports of crude. So if a president wanted to hurt U.S. production, they don't have to ban fracking. They can just restrict or ban exports of crude. Also, they can declare a climate emergency and use sort of defense powers to restrict production. So there is power there. I'm sure the industry hopes that she has turned a new leaf and is not supporting a sort of a gut punch to the industry. I guess we'll see if she wins, but she has enormous power, not to help, but to hurt the industry if she chooses.
And likewise, the other side of the coin is, of course, if Trump comes back in, he could indeed be injurious to Iran in terms of the largesse of their production at the moment. We didn't quite get there. Bob, thank you very much for joining us this morning, framing the geopolitical risk and the oil markets. Bob McNally there, President at Rapid Energy. Let's revert back to tech. We've got a nice bid with Taiwan Semiconductors, up 3.33%. We saw the revenue for last month up 45%, bolstering the AI narrative. Peter Elstrom is with me, Bloomberg's executive editor for Asia Technology. It's a nice booster for July for TSMC, Peter, isn't it?
It is. Now, this is just 1 month of data that we're getting out of TSMC. Like many Taiwanese companies, they report monthly revenue figures. It gives us a little bit of a signal about what the third quarter is going to look like for TSMC. The average projections for revenue growth there are about 37%. So this is above this, suggests that maybe TSMC is going to do a little bit better than expectations. Now, why is that important? It's because they make the chips for such key players in the market, including NVIDIA and AMD, as well as Apple. So investors may look at this and see this as a positive sign for demand, that NVIDIA is beginning to sell the chips, the new AI chips that they're bringing into the market. There's strong demand for those kinds of things. After the scare that we had earlier this week in the market, that may be somewhat reassuring, but again, it's just one data point, it's just 1 month, so there's some caution around that too.
Is there much of a read across on the broader implications of this? It's obviously something that helps the narrative. We've had quite a de-risking on big tech and in the Mag 7 and in the AI space. So what do you think the broader implications are?
I think the big question right now in the AI trade is not whether NVIDIA can sell chips or whether TSMC can make chips and then sell them into the market. The big question is whether the companies that are buying all those chips, the Microsofts, the Meta, Alphabet, Amazon, whether they're going to be able to generate revenue on the other side and show that these big multi-billion-dollar investments that they're making in AI services, AI chips, are actually going to pay off in the long run. And that's a question we just don't have an answer to at this point.
Peter, thank you so much. Peter Alstrom there with the very latest on TSMC. We'll run you through the schedule for the rest of the day in just a moment on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Let's lay the landscape out for you for next week. On Monday, the former President Trump is interviewed by Elon Musk. Tuesday, we get real insight to some of the inflation data here in the U.S. We've got the PPI followed by the CPI on Wednesday and retail sales. So again, really understanding the health of the consumer. We'll also get retail sales earnings from Home Depot on Tuesday and Walmart. That real pressure on the value end. To ground zero of risk, it is about dollar-yen, but also the bond market. Such an explosion in volatility in equities and bonds over the week. Round trip, 366 on the low point. You're trading at 395 right now.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The economy and the jobs market and the risk landscape is not exactly the same as it was several weeks ago.
The labour market deterioration, if it continues, well, then that could feed and create a downward spiral.
We think the Fed right now is pretty far behind. It's at a very restrictive level right now.
They are ridiculously behind the curve, irrespective of what the capital markets are doing.
The market finally woke up to the fact that more aggressive rate cuts will come with a weakening economy.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you all to the weekend and fast. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. What a week. Monday, the worst day for stocks since 2022. Yesterday, the best day for stocks since 2022. We've all been whipsawed left and right, up and down, all around. It's been vicious. Check out the scores this morning. Equity futures on the S&P 500, a little firmer, up 1/3%. On the NASDAQ 100, up 0.4%. Last week, the data was bad. This week, the data was better. Next week, the calendar's stacked. Danny Berger, let's go through it. August 13th, PPI. August 14th, CPI. August 15th, retail sales. A week later, Jackson Hole.
If that's the kind of data we have next week and we move to such a huge degree on claims, it's kind of worrisome. The fact of the matter is that we are just down 0.5% on the S&P 500 for the week. And Neil Dutta lays this out. It shows you that the risk is asymmetric going into next week's data, that we've rallied back to this point. If the data disappoints, you could have that narrative flip on a dime yet again to, I don't know, hard landing or something else.
I thought what Neil said was perfect. Economists worry about levels. They talk about levels. Markets don't care about levels. Neil was talking about this. What matters is change. Are things getting worse or are they getting better? And I think it's a much, much harder task to tell people right now that things are getting better. So we're all waiting for Chairman Powell in a couple of weeks. Were you waiting for this? Fed Chair Donald Trump, in a news conference yesterday, I have a better instinct than in many cases people that would be on the Federal Reserve or the chairman.
He said it's really a gut feeling, and given his past business experience, he knows where interest rates should be. What I found shocking about this is we have been asking former Trump officials on the record, behind the scenes, what happened to that Wall Street Journal report in April, this 10-page document allegedly the Trump campaign was looking at potentially how Trump would try to erode the independence of the Fed. Well, he kind of just said it right there. If he is going to be president, he would want to exert more power on the Federal Reserve. The issue, of course, is that the Federal Reserve gets their mandate from Congress.
Well, if he was able to do it, I was just thinking how incredibly helpful this would be for his aim to have a weak dollar, right? This is how you get it done. Because presumably you put in tariffs, you have tax cuts, that means that the Fed needs to hike, therefore you have a stronger dollar. The way that you can ensure you have a weak dollar is if you have control over Federal Reserve policy and can cut into that strength.
This is certainly a good way of getting people to run away from US assets, which would certainly certainly hit the US dollar. I'm with Anne-Marie. The first thing I did was pull up the Wall Street Journal article from August, which read as follows: Trump allies draw up plans to blunt the Fed's independence. And what do we hear from Trump allies over the last few months? They poured freezing cold water over that report, backed away from it, pushed away from it, questioned the sourcing in the piece, and then we hear it basically from the former president yesterday.
And in the economics realm, what we heard from the White House yesterday, Jared Bernstein coming out and re-releasing the report that the White House did after that Wall Street Journal report, basically talking about how it is so important to the fundamental economics of the United States that there is an independent Fed. So now this once again comes back up to as an election issue.
This has been breathless all week, so deep breath. Let's go through the markets together. Equity futures on the S&P 500 up by about 0.2%. In the bond market, we've had a massive turnaround in treasuries through the week so far. Yields this morning a little bit lower. We're down 3 basis points. Your 10-year, 395.51. Coming up this hour on the program, we'll catch up with Steve Major of HSBC on the bullish case for U.S. treasuries. Jeanette Lowe of Strategas as Trump and Harris agreed to debate. And Drew Mattis of MetLife following the S&P 500's best day since November 22. We begin with our top story. Treasury yields dropping after a week of wild swings. Stephen Major of HSBC remaining bullish on bonds, writing, ever so quickly the higher for longer narrative has collapsed. Explanations range from the technical to the fundamental, even the political. But whatever, the bond market has moved to preempt the Fed. Steve joins us now for more. Steve, it's been too long, sir. It's good to catch up with you. I'm going through your year-end price targets. Let me begin with them. 350 year-end, 3% by the end of 2025. Steve, let's go through that. What is the big bullish case for you and the team for Treasury bonds?
Well, these forecasts were set some months ago, Jonathan. They haven't changed. I think the first wave of bullishness in the bond market that we've just seen, and by the way, the bond market hasn't given up that much of its gains over the last week. It's pretty impressive how it's just performed. But I think the first wave is taking out the bearish view. So only 1 month ago, we were talking about reflation trades and various scenarios around the election. And the consensus positioning was for a bearish steepening. And that was based on opinion polls and probabilities, scenarios, etc. And I look at it now and I wonder, where's all that gone? A couple of months ago, people were talking about the case for keeping rates higher for longer. I think that was a very flaky, fragile kind of forward guidance. Again, that's gone. So the next move in rates is unambiguously down. The question is how much. If we get anything near 50 at the next meeting, and market is priced for between 25 and 50, then the market will set a price target of lower yield. So, you know, it could be that we get as much as the market is pricing in by year end. We could get more. The thing is, the market tends to lead the Fed, and I think you're seeing validation of that now.
Certainly what's happening at the moment, Steve. I just wonder how you think about the destination, the path, this conversation about 25 versus 50 in September. We've discussed that all week. Where are you on the destination? What's the end point for this cutting cycle once it starts?
Well, the muscle memory of bond traders and investors is 300 to 400 lower than the policy rate. So that takes you down to at least a 2 handle. I don't think the equilibrium rate and the R-star has actually changed since before the pandemic. We've done work on that. Others seem to think it's higher. If you think the R-star is higher and you try and add term premium on, you end up double counting. That's another point in the report there, that I think that the positioning is double counting term premium. So for me, 10-year treasuries should yield between 3 and 4. Having a forecast of 3.5 seems logical. I cannot explain why other people do what they do, but my suggestion is there's some double counting going on.
Stephen, I wonder when you think about the speed and the depth of your rate cuts and how that informs your view for where the level should be on treasuries. What is your North Star? Because this is a market right now trading that every single piece of data is a North Star.
Well, the thing is it? Because that might be part of the problem, in that we are being whipped around on every single cyclical data release and not putting sufficient weight on the longer run secular trend. And by the way, Anne-Marie, if you look back at previous cycles, you'll see that it was impossible to call the turn based on the payrolls data or the CPI or the ISM and that makes me wonder why people spend so much time talking about it. I mean, you can only use the unemployment data with hindsight. So it strikes me that everyone is trying to pass every bit of information they can to try and get an edge, a forward-looking edge. But the truth is, yields have been falling since October of last year. The front end of the curve failed 3 times to break above 5%. Look, we're actually entering a bull market for bonds here. We had a good year last year. We're having a good year this year. Bonds are not supposed to be generating double-figure returns. They're supposed to be the boring person at the party, a bit like me, really. The fun comes from all the other assets that you talk about. So if bonds can generate 5, 6, 7% a year, that should be just enough. And what they're doing right now is offering the perfect ballast in the portfolio, in a 60-40 portfolio or whatever. All that's come back, by the way. No one's talking about that.
Stephen, first of all, you're welcome at our parties anytime. I can assure you that. Are you telling me, though, you're looking at a trend here? Are you basically telling me that payrolls and CPI don't really matter?
Yeah, well, when you go down this route, you sound like a heretic. And I meet a lot of people who do give me a few funny looks sometimes. But I'm just saying, can we not put things in perspective and context? Because the cyclical data matters, but so does the longer run structural and secular story. And it's the more secular outlook that gives you your anchor. Your anchor is your longer run equilibrium rate. If you think it's 2.5, then the Fed's got a long way to go just to get to equilibrium. The terminal rate could even be below that. Other people think that the R-star, the equilibrium rate, is higher. I don't know where they get their information from, but they're basically just describing the forward rate. And in markets, you need to have a view that hopefully is better than the forward rate. Our view is that yields will be lower than what the forwards are saying. It seems to me that others think differently, but again, I can't talk for what other people are forecasting.
Stephen, earlier to Jonathan, you mentioned that the market was tracking some of the polling. I want to talk about politics and a Trump victory. Now the polling is much tighter. Yeah. So is the market pricing in a Kamala Harris victory?
Well, look, it's a great question because only 3 or 4 weeks ago, you can see what the polls were. It was 65% in favor of the Republicans, and now it looks more like 50-50. I'm sure you've got more precise numbers, but you know what I mean. And so if you take the probability of a sweep for the Republicans down, then you presumably move the market pricing away from reflation trades, whatever they are. My guess is a reflation trade means curve steepening for bonds. It may be good for equities as well. It may be a good thing for equities. But if you move to 50-50, then that's quite a big change, isn't it? And I think that was the butterfly wing that started to flap before all the other stuff that came in terms of BOJ, Fed, ISM payrolls, leverage trades, unwinds, all of this stuff. It's a confluence of events in these last few weeks. But if you want to look back at what started the change, I think you hit the nail on the head there. It may have been those few weeks ago when the probabilities started to shift away from the reflation trade.
Steve, can we do a bit of scenario analysis? What would happen if it shifted back? Yeah. What would happen if Donald Trump won in November and he was much more assertive about pushing forward with the tax cuts that they had introduced back in 2017, 2018 and rolled them forward? What if we saw something aggressive on immigration? What if, like he suggested yesterday afternoon, he would be more assertive about Federal Reserve monetary policy as well? Would that challenge the secular story that you've described that's ultimately this massive tailwind for fixed income?
It wouldn't challenge the secular story. It might give us a bit of a cyclical bump. Now, in the previous month's asset allocation that we published, it couldn't be a more different context to today. And actually, a month ago, I wrote about this reflation trade and the probabilities and the scenarios. If you want to think what the world would look like in a sweep scenario for the Republicans, then I think you'd have to agree that the curve would be a bit steeper. Many of the policies might add to near-term inflation, and there'll be all kinds of risk premia that we'd have to think about around all the policies. So it's the uncertainty that would add to the steepening pressure in a bearish fashion. But as we just discussed, that probability has fallen, and that means that the weightings are shifting towards soft landing and/or hard landing, if it was as simple as that. And I think that kind of backdrop favors lower yields in the near term. In answer to your question about the secular story, we're talking 5 years ahead, 5 or 10 years ahead.
Yeah.
I don't think even that would be disrupted too much.
Steve, this was great. I've known you a long time. Been for beers with you. I can say on the record, you're not boring, Steve. We know that. Steve Major of HSBC. Steve, thank you, buddy. It's good to catch up as always. The 10-year yield down by about 3 basis points this morning, 396. Danny, Steve's looking for 350 year-end, 3% by year-end next year.
So one of the, I guess, devil's advocates calls against that would be someone like Goldman Sachs, who says that we expect more growth. We still expect a strong economy, and therefore yield should be at 4.25%. But I think the fascinating thing about Steve's call is that it's not necessarily about each individual data point that comes in. I mean, he went so far as to say we're kind of missing the forest for the trees, just concentrating on payrolls and CPI, that we have a neutral rate, and in order for the Fed to get there, there needs to be a lot of cuts, so the direction of bias is yields down.
I have to say, based on what I've heard from the Federal Reserve so far, do you hear that from Fed officials, that they're willing, ready, even remotely prepared to validate what's being priced into this market right now?
Not at all. It is night and day hearing commentators on Wall Street and hearing the Fed. They keep saying this refrain, we have more time. Things are strong. We have more time to figure this out, to let inflation play out. That is not a Fed that is saying we're behind the curve and need to cut 50 basis points.
Fed presidents Daly, Barkin, Goolsbee, Schmidt, all in the last few days, nowhere near where this market is at right now. Maybe that changes. Maybe they're waiting for Chairman Powell and Jackson Hole to be the North Star for them and change all of this. But right now, they're not validating market pricing at all. Equity futures right now on the S&P 500 positive by about 0.1%, just about holding on to gains, with some stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Microsoft said a group of hackers linked to the Iranian government tried to breach email accounts of presidential campaign staffers as part of a wider effort to gain intelligence ahead of the U.S. election. The company revealing attackers linked to the Islamic Revolutionary Guard Corps used a compromised email address from a former political advisor in a phishing attempt on a high-ranking campaign official. It follows a warning from U.S. intelligence officials last month that Russia, China, and Iran were recruiting people in the U.S. to spread propaganda. Iran has denied that allegation. China's consumer prices rose more than expected in July, climbing 0.5% from a year earlier. Bloomberg's survey expected a rise of 0.3%. The jump was largely due to seasonal factors such as weather, leaving intact concerns over weak domestic demand and boosting the case for more policy support. Meanwhile, core CPI rose 0.4%, the least since January, indicating lingering weakness in overall demand. And TSMC reporting revenue jumped 45% in July, accelerating its growth from the June quarter and bolstering hopes for sustained demand for AI chips. Taiwan Semiconductor is seen as a bellwether for AI demand, as it's the go-to chip maker for some of the biggest AI companies like NVIDIA. For the third quarter, analysts expect TSMC's revenue to grow 37%, but the July numbers suggest the company may surpass those estimates. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, setting the debate stage.
I just look forward to these debates. I think it's very important that we have them. I hope she agrees to them.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it.
So no more debates about the debate. We've got an agreement? Good. That conversation up next from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York, we're almost there. The weekend just around the corner. Equity futures on the S&P just about positive by 0.1%. Yields lower by 2 or 3 basis points. The 10-year 395.89. 20 minutes into the program, haven't even mentioned dollar yen. It's a good morning. Dollar yen 147.20 and just about unchanged. And there's your why. That's why we're not talking about it. And that's a good thing for many of you, I'm sure. Under surveillance this morning, setting the debate stage.
I just look forward to these debates. I think it's very important that we have them. I hope she agrees to them September 4th, September 10th, September 25th. And I think they'll be very revealing.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it and hope he shows up. I'm happy to have that conversation about an additional debate for after September 10th, for sure.
So here's the latest. ABC News confirming Vice President Kamala Harris and former President Donald Trump have agreed to a presidential debate on September 10th. The two sides hitting the campaign trail in full force today. Harris holding a rally in Phoenix as Trump heads to Montana. Jeanette Lowe, strategist, joins us now for more. Jeanette, this has been agreed. September 10th is the date on ABC. I just wonder from your perspective, who is most at risk going into that?
I think that Trump is a little bit more worried about his positioning since Harris has gotten into the race and is now the Democratic nominee. So I think he is actually looking at this to try to have a similar debate as he had on June 27th against President Biden. So I think there's more risk there. What we're definitely seeing since Harris has gotten into the race is a lot more momentum on the Democratic side. You've seen the national polls, a 3.5 percentage point move from Trump, who had been up about 3 percentage points, to now Harris being up just as about a 0.5 percentage point. In the swing states that matter for this election, you've seen a move of more than 2.5 points in Harris's direction. So now we really do have a 50-50 race where it could be very close come November. And I think he really wants to use the debate to try to re-highlight and be able to attack Harris on some of the key issues that he thinks are lacking now.
Jeanette, he also, yesterday in his press conference, Donald Trump floated 2 other debates. Who is more at risk of having more debate time when it comes to not just on this ABC News one, but Trump was floating an NBC News debate as well as a Fox News debate?
You know, it's interesting. So obviously, I think the June 27th debate was probably a bit of a surprise to many people. Usually the incumbent president does lose their presidential debate, but that was just quite a different debate than I think anyone was expecting. Trump could be more disciplined in the debates, as we saw in the June 27th debate, but at the same time, there could be, different reactions, kind of like what we had in his press conference yesterday, where that could actually hurt him. Now, if Harris is also on the defensive and he's actually able to get a lot of blows, that can hurt her. So debates can actually be quite up in the air. I think that's why we also kind of want to see what happens in this first debate and if that means we want more than one. Usually, obviously, we do have 3, so I think Trump is now trying to go back to that traditional mode, but that's also a lot in a couple of weeks right before the election, so we'll see what happens.
We also heard from Kamala Harris yesterday, the vice president, talking about the fact that her team has scheduled, or she's asking her team to schedule a sit-down interview before the end of the month. Unclear if that means it's going to be scheduled for August or potentially September. But there was also reporting that they would maybe want to sit her down with her VP pick, Governor Walz. Do you get a sense that the campaign is trying to shield her from some of these more direct confrontations with journalists?
I think it's unclear. I think one of the things that this has been a very fast campaign, so it's only been 3 weeks. I think to some extent she might be still trying to get her feet under her and make sure that she kind of knows what her policy positions are. So there could be some of that in part of the delay as to really being doing more of these interviews. But I think also she's kind of has the momentum at this point. Now, she is a better debater. She is better in front of the camera, I think, than she has been in the past. So I think that does have a benefit for her. But there could be other factors that I'm not quite sure exactly what they may be. But I think this is something that the Trump campaign is now trying to latch onto to try to make that, saying that she won't show up in front of the press, she won't do interviews, and she won't take questions.
Jeanette, she's been vice president for about 4 years now. Is it a problem? She doesn't yet know her policies?
Well, I think it's also just, you know, as a vice president, she's trying to toe the line of what the President Biden wanted. Right now, you know, we've seen that she is not taking necessarily the same positions that she took as a candidate in the 2020 cycle. So things like fracking, she's trying to like moderate her position on Israel a little bit. I think these are the things that she wants to really make sure she has really ironed out better, because obviously we know in this news cycle that people love to take anything that you say and then kind of spin it. So I think she also wants to make sure she does have her messaging down, but she does also have a risk there that if she's actually not showing up in front of the press and she's not able to answer questions and talk about her policies, that can also be a risk for her campaign as well.
Jeanette, just before you go, quite clearly the vice president is driving enthusiasm at the top of the ticket. How are Senate and House races evolving since Biden dropped out and she stepped up?
Yeah, so one of the biggest things that we've seen is that since Biden got off the ticket and Harris is now the new nominee, we've seen the odds of a Republican sweep drop quite a bit. They were at 55% on July 16th. They're now down to 32% this morning. And you also have 25% odds of a Democratic sweep and 25% odds of divided government in the scenario of a Democratic president, Democratic House, and a Republican Senate. I think what's interesting about this cycle is that you could have divided government under either scenario, whoever wins the presidency, just because the margins are so tight right now in the House and the Senate. So for instance, if Harris is getting a lot of momentum, the Democrats only need a net 4 seats to win the House. And those are seats that are also in states like Alabama, and there's 1 seat in Alabama. There's seats in California and New York and New Jersey. The Democrats do have an opportunity to flip this cycle. So if she has momentum, even if she doesn't win the presidency, there is still a possibility the Democrats could have control of the House. On the flip side, the Senate does look like it's going to move to the Republicans because you have Senator Manchin no longer running in West Virginia. I think that becomes a Republican pickup. And then also John Tester is currently down in the state of Montana. And so that could be another pickup. So there is this interesting dynamic where we could have divided government no matter what. So I think that that's something that we need to look forward to because it's obviously going to have big implications for what policies can be enacted next year, and particularly as we're talking about the debate, it's about taxes and the debt ceiling debate.
Jeanette, got it. Just fantastic as always. Jeanette Lowe there as Strategas. Scene. The vice president hasn't answered any questions. So she approaches you and says, what questions have you got? And you respond by saying, when are you going to answer questions? What were they doing yesterday?
You could have also just said, here's a question for you.
You know, like start asking some questions about policy. Honestly, from New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
We are on course for a fourth week of losses on the S&P 500, potentially, and we could have raised them a little bit later on, but potentially the longest weekly losing streak of the year so far. Equity futures right now on the S&P positive by 0.2%, on the Nasdaq 100 up by 1/3%, on the Russell up by 0.4%, and I think we've firmly established, Danny, that good news is good news and bad news is bad news based on the incoming information and how this market's responded to it.
Well, to be clear, the good news was jobless claims that surprised to the downside in a good way by 7,000 people. We had the biggest rally since 2022 because 7,000 people in the entirety of the United States did not file for jobless claims. I think that says a lot about where this market is, that we're just grasping at things, trying to get a handle, and the market will chop both up and down until we do.
We've had some great guests this week. I think one of the best, Jim Karen, Morgan Stanley. Jim said the last few weeks you've learned more about the positioning than you have about the fundamentals. And to your point, jobless claims, great example of that.
Yeah, certainly. And I mean, you even look at what's going on with the yen. We all look at the yen today and we say, oh, great, it's being calm. Well, of course it is. Nothing is going on with the BOJ today. I think everyone is just looking at every move in the market with bated breath, that they feel like because you had this big volatility upset on Monday, that more could be on store. You have other people celebrating the fact that the volatility has calmed down, and maybe that's a fool's errand.
Just waiting for the next data point to get whipsawed all over again. Switch at the board and turn a page, and let's go to the bond market. And I've mentioned this a million times this week, but still, I think it's stunning, and we should talk about it again. The 2-year at the start of the week, the low on Monday was 365, just south of that. On a 2-year, we're just north of 4%, 4.03%. It's kind of remarkable to see where the 2-year was Monday morning, how the world felt, and where we are at the end of the week.
This is why when people say, look, bonds did their job. They protected you on a Monday when stocks were selling off. That basically papers over the fact that yields are indeed higher on the week, that you have a market that had this big convulsion, and bonds convulsed too. You had so much volatility in an asset class that's supposed to be the staid part of your portfolio. This is supposed to be the boring part that doesn't move a lot, and it didn't give you that this week, even if it did give you some protection.
How many bond people have been on this program in the last week who have looked actually quite excited? Quite excited that like their world was where the fireworks were for once.
Right.
Big time.
The revenge of the bond nerds. And it's this kind of, you know, this idea of, look, bonds have been pricing in something worse for this economy for a while now. You equity guys have been living on a hope and a prayer that everything's going to be wonderful, and now you're coming around to our camp.
These Steve Majors of this world over at HSBC feeling very validated by the last few weeks. I want to turn to dollar yen. Danny mentioned it. Dollar yen's just about unchanged, so nothing's happening here whatsoever. 147.18. I think you've got to put two things together this week. The data calmed things down a little bit. Wasn't just jobless claims, it was ISM services as well. And the BOJ backing away from things just a little bit too. I think just took some pressure away from this story for now. Whether it comes back, I don't know. The fact of the matter is dollar yen is about to post a week of gains for the first time since June. That's how vicious things have been the other way in dollar yen.
Well, I think the worry for this market has to be is we've seen ties in different parts of this market that we didn't necessarily think were there. For example, big tech sells off at the same time you have yen appreciating. Are they now so interconnected that, you know, we get NVIDIA earnings at the end of the month? If they're really bad, do you see a yen appreciate? I mean, that would be kind of crazy under any circumstance, but I think we need to ask those questions after a day like Monday.
It's a bonkers world, not just Monday, but over the last few weeks, that's for sure. Under surveillance this morning, if you are just joining us, just an update on where we are with the Fed speak. Kansas City Fed President Jeffrey Schmidt signaling he's not ready to support an interest rate cut, saying we're not quite there in calling inflation, and the labor market still appears healthy. This word healthy is something that's come up a few times. We've heard from Barkin, we've heard from Daly, we've heard from Gorsby, we've heard from him. And I have to say, they all seem to be on a similar page. Are we ready to cut interest rates? We're getting close. Looks like it's going to happen in September. Are we ready to validate market pricing? I mean, my word's not theirs. I'm just going to infer, based on what they've told us, they're nowhere near ready to validate market pricing.
It's not even the pricing, it's the conversation. Just to add more Fed speak to the mix, Fed President Susan Collins sat down with a paper in Boston, and she said that we are going to have rate cuts soon, so perhaps the most dovish speak of all of them. But her justification is that if CPI keeps falling, the Fed is still talking about inflation. The Fed is still talking about getting back down to 2% as the most important part of the dual mandate. The market's moved on from this, and you can see it in the reaction to the data. We care more about unemployment than we do CPI. But the Fed, again, in their conversations, still talking about inflation as the guiding star.
After we heard from Mr. Rosenberg yesterday, basically saying we might be in a recession. And he's saying that what everyone's discounting is the fact that look at what's happening with hiring, not firing. I was struck by what Thomas Barkin said yesterday. He says there's no hiring, there's no firing. That's what we're seeing in the data. And he says that's what he's hearing on the ground in his district, in his state. That's what business leaders are saying. So he pretty much sees this normalization, but basically saying it could go either way.
Danny's absolutely right. There's a dual mandate here, full employment, price stability. The market's gone from focusing on price stability to exclusively on the labor market side of the mandate, and the Fed's sort of balanced between the two right now. That's what it feels like. That's what it felt like with Chairman Powell in the news conference in the last few weeks. That's what it looks like based on what we've heard from Fed officials.
And the risk with that many people will say is you can say, look, we're not worried about these labor markets because sure, hiring is not great, but no one's getting fired. The risk is always that once layoffs start is that you're too late. You know, it's kind of like the beach ball being held underneath the water that when you let go, it just shoots higher. So by the time layoffs happen, if that's when Fed officials wake up to that reality, the argument goes that they are far too late.
This self-reinforcing process has started. That's the view of the bears right now. Danny mentioned inflation in America. I need to talk about CPI out of China, coming in higher than expected for the month of July. Seasonal factors like weather driving the rise, leaving intact concern over sluggish domestic demand and boosting the case for more support. It's interesting to hear from a couple of economists on the street, in fact, not just in the United States, but worldwide, the reluctance of Chinese officials to really loosen up fiscal, and they were reluctant to do so until maybe 2025 once they've worked out what it looks like politically here in the United States. And that's quite a take at the moment. I think that's consensus for many people watching that economy.
Well, because the state council came out with a plan to boost domestic demand. They were going to have to inject some fiscal stimulus into the economy. But Goldman Sachs said, hold on, we think China's actually holding back on the firepower because they might need that ammunition if there's going to be a Trump presidency and he puts up the walls, including 60% tariffs on all imports coming from China.
Not just if it's Trump or Harris, we still need to work out what Harris's position actually is. What is the vice president's position on China, tariffs and policy for trade worldwide?
We don't know. That's the point I think you made earlier, Jonathan, the fact that she goes over and talks to reporters and what they want to ask is, when are you going to sit down for us to ask these policy questions?
Blows my mind.
I imagine, though, she has been the vice president for under Biden, and it will be a similar trajectory. So they're going to keep some of those tariffs, but no one's talking about in the Harris camp about putting up a tariff ring, a wall around the United States.
I think we're all hoping for a quiet end to the week. Looking ahead to next week, though, things get very busy. PPI, CPI, retail sales, all next week, and we're all looking for evidence of a soft landing. Drew Mattis of MetLife writing the following: while risks of a more significant downturn have risen, given that the equity market volatility may have prompted some additional concern from higher income workers, we continue to expect only a moderation in growth. Drew joins us now for more. Drew, great to catch up, sir, as always. Let's get straight into it. Why are you only expecting a moderation in growth? Where does that more constructive view, Drew, come from?
Well, I wouldn't call it more constructive. What I'd say is that...
I'd certainly say it's more constructive relative to what we've been pricing into this market over the last week, Drew, wouldn't you?
Well, one of your guests yesterday basically said, I was here and the market went here, and then it's coming back, and he's been unchanged, right? And that's where we are. Is there's going to be this moderation growth. What I think people are really missing with regard to the labor market story is hours are continuing to fall, right? There's a limit beyond which, when hours fall, you'll start firing people, right? Because you're paying people to do nothing, and we're seeing a lot of paying people to do nothing in the data. And it's only really a matter of time before companies have to kind of justify paying those people to do nothing. And so, calling the labor market healthy, is the housing market healthy because no one's transacting in it? I don't think so. It doesn't look healthy to me. So why would the labor market be healthy if no one's transacting in it?
So, Drew, build on that for me. When you look at Fed policy at the moment, how wide is the gap between where you think the Fed is and where it will be and where you think it should be?
I mean, they should have been cutting months ago, as people like Neil Dutta have been suggesting. And, the fact that they waited now doesn't mean they can play catch up. They tried this before with rate hikes, right? They missed the bus. And instead of trying to just kind of gradually move policy where they needed it to go, they decided to run after the bus on their skateboard, and they got hit and taken under the tires, right? So they don't want to do that again. At the same point, the weakness tends to actually gain momentum. And so I think, what we've seen with claims, for example, people are excited that claims went down last week. The average, if you just kind of get rid of all the volatility week to week in claims, is still towards weakening labor markets. It's still towards more people filing unemployment insurance claims, particularly when you look at it as a percentage of the population that's allowed to file for claims, right? So not every worker can file for them. And when you look at it that way, it's pretty much a straight line higher. And that's something that should worry everyone, including the Fed, which should be thinking to themselves, what's the peak in unemployment that we want to accept? And when do we have to cut rates to get there? And I think they've already missed the boat if they were hoping for 4.5 to be the peak in unemployment. The question is, do they want the peak to be above 5 or below 5 at this point?
Drew, can you square something for me then? Because you sound quite concerned. The trend is getting weaker, as you described. But am I right in that you only expect 75 basis points of cuts this year? You sound like you would want to be more dovish than just 75 basis points of cuts, given everything you just said.
Well, a month ago, I was perceived to be more dovish, and people were, internally and externally, were like, really, you believe 75 basis points of cuts this year? And so, rather than me adjusting myself, I think everyone else's view on what it takes to actually get to a better place has kind of gone off the deep end a little bit. And you've seen that reaction in the bond market. You've seen it with Fed funds expectations, where people are expecting 125 to 150 basis points of cuts by the end of January, which is the first meeting that the Fed has in 2025. And you see it in the 10-year, right, where, below 4% is not where the 10-year should be, given the state of the economy, the state of inflation, the state of the budget deficit. And what you can expect maybe for productivity going forward once people begin to actually harvest the gains of artificial intelligence.
So Drew, in a world where the market is right, what does the economy need to look like in order to get 100+ cuts this year?
I think you need the unemployment rate fast approaching 5, so the pace of the deterioration, the unemployment rate doesn't slow down. And I think you need to see inflation come down maybe more than it will. We're not worried about inflation, and we don't think the Fed should be worried about inflation. If the unemployment rate's going up, you can count on the inflation rate going down, and I think that's the trade they're going to make as they approach the end of the year. But we still think that they're going to be cautious there, right? The pace of the slowdown is still a relatively moderate pace of slowing, even though we are expecting unemployment will continue to move higher.
Drew, so you think the Fed should have already been cutting months ago. Yesterday, David Rosenberg said to us the Fed is, quote, ridiculously behind the curve. He also mentioned something in the data that you're talking about, which is the fact that hourly work from individuals is starting to fall off a cliff. But he thinks potentially we're in a recession. Do you share that view?
I don't think we're there quite yet, but I'm not sure if it's a coincidence that David, Neil, and I all worked together back in the day. We tend to look at the world for what it is, and what it is right now for an employee. Are you going to go to your boss and ask for more money next year?
Yes.
Despite that inflation. When no one's getting hired if they get fired, right? No one's going to put their hand up there. And that's the part of the equation that people are missing. Oh, well, no one's being fired. It still affects the dynamics of the labor market and still will affect the dynamics of consumption.
Drew, everybody should do that. Go away. Drew Mattis of MetLife. Thank you, sir. It's good to see you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The U.S., Qatar, and Egypt are calling for a new round of ceasefire talks, the latest effort from the Biden administration to end the war in Gaza. Israel said it will send a delegation to the talks scheduled for next week, while Hamas did not respond. U.S. officials now say a deal is closer than ever, even as the region braces for an expected Iranian attack on Israel. Paramount Global saying it will cut about 15% of its workforce, amounting to about 2,000 jobs, as it prepares for its merger with Skydance Media. The parent company of Nickelodeon and MTV reporting earnings that beat Wall Street estimates after its streaming division, like Disney, swung to its first ever quarterly profit. But like Warner Brothers Discovery, Paramount took a second quarter impairment charge of $5.98 billion on its cable networks, marking another sign of weakness in traditional TV. And former President Donald Trump saying presidents should have more say over interest rates and monetary policy. The move would go against the long-standing tradition that the Federal Reserve is independent of political actors. Trump telling the media from Mar-a-Lago that the Fed has been a little too early and a little bit too late in moving rates, and that he may have better instincts than those at the Fed. Powell has pledged not to let politics influence his or the FOMC's decisions. That's your Bloomberg Brief. John?
Yahara, thank you. I want to pick up on that story. Based on those comments, do we go back to that Wall Street Journal story of April this year? The headline read, Trump allies draw up plans to blunt the Fed's independence. Is this about blunting the Fed's independence through some kind of formal channel, setting policy to do so? Or is the former president saying that if he comes back into the office, he'll be as loud as he was before about offering an opinion about where Fed policy should be? Which one is it?
It's hard to understand, but these are the most direct comments we've seen him talk about Fed independence. The word he used yesterday was gut. He said, you know, the Fed kind of gets it wrong. They're tending to be a little late on things. Maybe he gets a little bit too early. You know, there's very large a gut feeling, and I believe, you know, I have that gut feeling.
We'll try and get some more opinions on this for you throughout this morning. Up next on the program, the turning point for a soft landing.
I still think that we're either in a recession or about to confront one. I am definitely not one of those people that would say to you, it's different this time.
That conversation up next, live from New York. You're watching Bloomberg TV.
About artificial intelligence. Is artificial intelligence going to enable you and others to say we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I don't want to jinx this, but this is what a calm summer's morning is meant to look like. Equity futures not doing much, up 0.1%, no data, not much Fed speak, very light on earnings. In the bond market, yields a little bit lower, down 3 basis points, 3.95. Earlier this week, people freaking out about dollar yen. Dollar yen is almost totally unchanged on the session. This is how you want it going into the weekend. Let's hope it stays this way. Dollar yen 147.14. Under surveillance this morning, the turning point for a soft landing.
I still think that we're either in a recession or about to confront one. What's tried, tested, and true is the unemployment rate. And the unemployment rate is up 0.9 of a percentage point over the past 15 months. When you're up 90 basis points or more in the unemployment rate from the cycle low, you go into recession 100% of the time. I am definitely not one of those people that would say to you, it's different this time.
Is it different this time? Here's the latest, a full slate of economic data ahead next week, headlined by Wednesday's CPI report and a double dose on Thursday with retail sales and another round of jobless claims. Paul Donovan of UBS taking a balanced view on the economy, writing the following. Equity markets have been meandering rather than moving with clear direction. The unwinding of more speculative trades should have concluded, allowing economic fundamentals to gradually reassert themselves. Paul is with us now for more. Paul, I'm happy to talk about fundamentals with you, so let's go there. Walk us through how much stress, Paul, there is in the US consumer and whether you can identify whether it's starting to migrate from low-income households to middle-income households and maybe even further.
Well, it is the middle-income household that is critical because that's the consumer that really is behind the growth. Now, the bottom 30% of income distribution, of course, they matter socially, they matter politically, but they don't have the spending firepower that the middle-income consumer has. And to be honest, if you are a middle-income consumer, as a household, life's pretty good. Very low fear of unemployment. You've got a job, you're not losing a job. You're seeing increased female participation. And what's critical here is women are taking jobs paying above average earnings. They're moving up the quality because flexible working is giving childcare providers a lot more ability to take high-quality jobs. That's enhancing household spending power. You're in a low-inflation environment. If you're a middle-income household, remember the nonsense of CPI, despite Powell's absurd obsession with it. CPI overstates the cost of living for middle-income households. All of this is really beneficial, and I think it means that the middle-income consumer is going to continue to put in a pretty solid performance.
Paul, I love the phrase that you've said for a while now, not to short the hedonism of the American consumer. And so far, that has played out correctly. I just wonder, in your view, what does it take for that to deteriorate?
So the thing which would really cause me concern, the one thing which is going to stop you guys going to the shopping mall or, spending money you don't have on things you don't need, the one thing that would cause that to come to an end, I think, is a significant fear of unemployment. But fear of unemployment is not driven by temporary job layoffs, which is all of what happened last week, pretty much. Fear of unemployment is when either you are seriously concerned that your permanent job will be taken away from you, or friends and family are experiencing that. And we're just not getting that at this stage. But fear of unemployment is what we've got to look at, and that is job losses for permanent workers and more widespread, not sort of geographically or sector concentrated.
I know Monday was only a blip, and you're talking about seeing friends and family lose their job and fear of that. But if the market were to have more days like Monday, where you just have, I don't know, it could be a data print that is not really representative of the overall economy, but you have more things like that, is that enough to have that feedback loop that you're talking about? Can the market do that job?
No, I don't think so. So here's the thing, which we sort of whisper about in my profession. Financial markets aren't as important as they think they are. In the real economy, it's not the large listed companies that dominate employment. It's the mom and pops, the Mittelstand in Europe. It's the small, medium-sized businesses that dominate employment, that dominate things like job security and so forth. So the market going up and down, yes, there's a bit of a wealth effect. You've got to remember, most Americans don't own a lot of equity, and the equity they do own is indirectly held through 401ks and similar. So the fluctuations of the market don't sort of immediately lead to correcting behavior on the part of the consumer. Now, house prices, they're a lot more significant in terms of affecting consumers' perception of their wealth. But otherwise, the ups and downs of the market, the fairly wild swings that we were seeing earlier this week, very limited feedback loop at this stage.
I want to ask you about what's going on in China, because you talk about in your note this morning, we did have inflation tick up slightly, but this has to do with weather effects and food. The issue is demand. Do you think the Chinese economy needs a monetary policy approach to this, with the PBOC potentially cutting, or do they need to pump some fiscal stimulus into this economy?
Well, my view here is that it really needs more on the fiscal side. It's not really a credit-constrained economy. That's not what we're seeing. What we're seeing is an unwillingness to spend. Now, this may be fear of unemployment coming through. We've got to remember that particularly youth unemployment, even on the official numbers, is still quite high, and the expectation is that it's probably higher than the official numbers portray. There's also concerns about the need to rebuild savings post-pandemic, in the absence of a particularly robust welfare state. So in that situation, I think easing the cost of credit has a fairly limited impact. I'm not saying it's zero, but it's not going to be the main driver. Really, what you've got to try and do is boost consumer demand through consumer confidence, through giving people a greater sense of security about their economic futures.
Do you agree with some of your colleagues on the street, though, that potentially China is holding back and waiting till we get the results of the U.S. presidential election?
I'm not sure that that is necessarily the case. I mean, I think China is going to try and achieve its 5% growth target, because China always tries to achieve its growth target. And in that situation, I think we're getting this sort of drip of stimulus measures, a little bit here, a little bit there, easing in this provincial fiscal policy, bit of an easing on the credit condition side. And that's to try and maintain, on the official numbers again, around about a 5% growth rate. Now, the thing is, if President Trump does come in and wins re-election and puts in place a 60% tariff, and it's not just a sort of a bargaining tool, that would be very, very disruptive for the China economy. The universal tariff would probably also be very, very disruptive for the China economy, and that would then require additional measures. But that's such an extreme situation, U.S. would probably end up in recession as well. So you've got a really compounded problem that would require separate measures. There's no point waiting and umming and ahhing about does Trump win or does Harris win. I think China is going to focus on its 5% domestic target for growth and achieve that, independent of what is going on in the exciting world of U.S. politics.
Paul, it will remain exciting, I'm sure, for the next several months and maybe even a long time. Much, much longer than that. Paul, thank you, sir. Paul Donovan there of UBS. I want to just get to Paul's comments on the labour market and the U.S. economy. That fear of high unemployment, in Paul's mind, hasn't gripped this market, this economy, just yet.
When he says the market thinks it's more important than it actually is.
Isn't that always the case?
Yeah, it always is. But I also love his view of the American consumer. Like, you are spending money that you don't have. I feel like kind of directly...
On things you don't need?
On things you don't need, and that's going to continue until, you see your sister, brother, parents lose their job.
It's funny, that felt personal to me too. I think it felt personal to a lot of you. Coming up in the next hour, Bloomberg Surveillance, Anastasia Amoroso of iCapital, Congressman French Hill of Arkansas, Deborah Netschert of Jennison Associates, and Megan Swiber of Bank of America. With futures just about positive by 1/10%. You're watching Bloomberg TV.
It's the world's second largest economy, with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
what's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one. I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is.
There's a higher risk of recession. It's zero, but it's still not a base case for us yet.
I still think that we're either in a recession or about to confront one.
I don't think that we're at the point yet where things are tipping over the edge where the Fed's going to have to start cutting 50 basis points.
There are pockets of weakness, but overall, the U.S. economy remains in solid shape, and that's the story I like to tell.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I bring you better news. Things are quiet, snoozy even. Start going to the beach already? I don't know, but things are better. Equity futures on the S&P 500 going virtually nowhere. On the S&P, we're positive by about 0.2%. On the Nasdaq, up by 1/3 of 1%. Let's see if it sticks. But just to take the temperature of where things are this morning, nobody's talking about dollar yen. Dollar yen is basically unchanged on the session at 147, and we can put our hands together and hope it remains that way. 147.13 on dollar yen. Things get busier next week, so let's get to the calendar. CPI, PPI, retail sales. Jackson Hole a week later. Danny, the stage is set for a very interesting speech from Chairman Powell.
And it's interesting to think about what they'll care more about in between those individual data points. You have to assume for this market it is retail sales, because if we are worried about a downturn in the economy, if we are worried about the consumer, considering what we've heard from earnings, retail sales will be the most important for us. But the noise from the Fed is still inflation.
This week's very different to last week. Last week we had bad data, ISM manufacturing, jobless claims, payrolls, the unemployment ticking higher once again. We had the BOJ hiking interest rates and suggesting the bar was pretty low to go again. This week, like the reverse of that. Data's a little bit better, jobless claims a little bit lower. That's good. We saw ISM services, that was better as well. In expansion is where we want it to be. And the BOJ backs away. That's the ingredients for things to settle down just for now.
But let's be honest, that data was tier 2 data. I mean, it was jobless claims. It was ISM. Not to say that they aren't important. I don't mean to be flippant about people applying for jobless claims, but it is usually not your North Star of data. If you listen to Stephen Major, none of it should be your North Star, that you just need to think that the neutral rate is lower, and we're going to head there, therefore you should be buying bonds.
And when it comes to data, I'm looking at what Mohamed El-Erian continues to say. What are the CEOs saying on the earnings call? So Expedia comes out. They have posted better than expected results, but they say they're seeing this softening demand. And the CEO said in July, we saw there's softening demand, concerns about the macro environment. So what they're saying about the future is that potentially less people are going to be getting on planes and booking hotels.
Airlines first out the gate, Delta, United, American, Ryanair on the other side of the Atlantic, all said the same thing.
And I think it all shocked us because travel numbers are high. How many times did we sit here before a holiday weekend saying it's going to be records at the airport, it's going to be a mess, there are going to be so many people. So for the airlines to turn around and say, actually, we are struggling, I think was whiplash for a lot of people. It could be what Torsten Slot from Apollo was talking about. It's that business class, first class, they are still doing fine. So all airlines are reflecting is a bifurcated economy.
That consumer softness, not exclusive, of course, to the airline business, the travel business. We're seeing that elsewhere as well. Just to check in on the scores for you, on the S&P 500, just about positive by 0.2%. A little bit of a lift in the equity market this week has included the biggest one-day loss since 2022 and the biggest one-day gain since 2022. Monday and Thursday, two very, very different sessions. In the bond market, yields lower by 3 basis points on a 10-year, 395.32. Coming up this hour, we'll catch up with Anastasia Amoroso of iCapital following the S&P 500's best day since 22. Congressman French Hill on whether the president should have an influence on Fed policy. And Megan Swiber of Bank of America now expecting a greater degree of curve steepening. We begin with our top story. Stocks posting their best day of gains since 2022 following the right kind of downside surprise on jobless claims. Anastasia Amoroso of iCapital writing this: markets may be getting sufficiently close to pricing in current recessionary odds, and pullbacks may be buying opportunities, especially if the recession is averted. Anastasia's with us around the table. Anastasia, good morning.
Good morning.
Let's talk about the evolution of your year so far. Coming into the year, I would say more bullish than most, a little bit more conservative, I would say, through the back end of the summer coming into July. Where are we now? How has your thinking evolved?
Yeah, I think that's right. I would say in May, we wrote this piece where we talked about the reasons for optimism and the reasons why you wanted to buy the April pullback that we had. Then coming into July, we wrote this piece and said, look, we've had a stellar first half of the year, but here are the risks for the second half. And it's not like we were calling for those risks to materialize, but if you think about election uncertainty, that was on the list. If you think about slow consumer, that was on the list. And also this potential disappointment from AI and all the hype that we've had there. So we've sort of checked a lot of those risk factors. So now, when I look at the markets, you talked about the dollar yen. The reason why the U.S. market does not seem to care is because for us, the biggest risk is the recession. And how do we price in a recession? And this is why that's something that I was thinking about. To what extent have the markets actually reflected the recessionary odds? Well, the Bloomberg consensus of economists forecasts about a 30% probability of a recession. There's a range of estimates. So one of the Fed's models is looking as high as 50. The JP Morgan model may be looking something like 43%. But when you size that relative to the market pullback before the bounce back yesterday reflected also a 30% probability. And so we're kind of at this, 200-day or 100-day moving average to fully reflect, I think, some of the worst forecasts for the recession. I would say we need to pull back another 5%. So when I look at that setup, John, I say we're sort of within the strike zone of, getting close to pricing in the recession based on what we know today. But especially if we avert a recession, buying within the strike zone between a 100-day and a 200-day moving average, that seems reasonable.
So the price of the story is where you're focused. There'll be a lot of people obsessed with asymmetries. They always are. When you think about how this market is more sensitive, is it more sensitive now to better data or worse data? How do you think the setup will sort of play going into next week, which is a big week for economic data?
Well, I think we have reset this quite a bit. If you would have asked me this probably a week or two ago, I would have said, definitely, we're more sensitive to worse data, because that was, by the way, one of the things we worried about in the beginning of July, this disconnect between the elevated earnings expectations and the economy that was clearly slowing. But now that the economic surprise index has been negative for months, and now that we've priced in these greater odds of the recession, I would say the market is probably going to be more sensitive to any sort of positive surprises. And by the way, we might see that, maybe not from retail sales necessarily next week. They're expected to be pretty sluggish. We might see that from the payrolls data going forward. I mean, there are a lot of opinions out there, but if you look at the numbers, the 4.3% unemployment rate, a lot of that has to do with new entrants into the labor force, the immigration that has occurred. But specifically in July, it's the pop in temporary layoffs. I do think that some of that may actually reverse, and there are estimates out there that look at what payroll creation might have been had it not been for Hurricane Beryl that hit Texas. So I think we are likely geared for that positive surprise in the coming months.
It's a blessing and a curse just listening to you talk of all of the data we have. We literally are swimming in it right now, not to mention that it's also earnings season.
Yeah.
And sure, the talk from the companies, some of it with the consumer has been a bit dour, as we've been discussing. Earnings growth is really strong. It's something like 10% for the quarter so far for the S&P 500. Globally, the best quarter in 8. How do you square all of that together?
Yeah, I think earnings growth, especially for non-Mag 7 companies, is actually surprising to the upside and is expected to pick up in the back half of the year. So I think that's, again, maybe the underappreciated story by the market. And look, I'm not in a recessionary camp. I'm in a soft landing camp. And I do actually think that some of the companies that are sensitive to interest rate cuts, like financials, like regional banks, like real estate, they may be benefiting from that as we progress through the year. So I would see some upside to the non-Mag 7 earnings picture.
So when you have a day like Monday where Mag 7 sells off, do you not touch it, or are those dips you'd want to buy?
I mean, most people are probably sufficiently overweight, or at least market weight the Mag 7. So I actually don't think that's the first place you look. What most people are underweight is either the defensive trade or the rotation trade. And I'm going to come back to semiconductors here in a minute. But I do think in an environment where the economy is slowing, we're not recessionary, but we are slowing. You want to step into sectors like utilities, for example. You want to buy bonds, specifically municipal bonds, if you're a higher income consumer. You want to buy the rotation trades like real estate and regional banks because I think people started that rotation. It was sort of short-circuited, but I think it's the right place to be if the Fed is cutting rates. And that brings me back to semiconductors. People are probably sufficiently overweight semiconductors, but if you look at the pullback in valuations, we're not quite, but we're getting close to the lows that we've seen in the last year. And the earnings expectations for AI semis in particular are still going up. So I think that's a great setup.
You mentioned utilities. Is it back to being a bearish play or defensive play? Because at one point it was an AI trade.
No, it's definitely a defensive trade at this point. And I mean, let's not forget there's absolutely still the potential for AI upside, and the fact that we need to almost double our electricity generation capacity in order to service the data center and the AI opportunity. But no, it is back to being the defensive trade. It's the fact that it does have a yield that is higher than the market. It's the fact that it does have economic resiliency. And when we look at how utilities in particular have performed, they've held up better than most sectors going into the first rate cut and coming out of it in the 3 to 6 months period after that. So I think a lot of people are paying attention to that. And look, this is a two-way market now. I think there's risk to the upside and the downside, and that's why I think a lot of investors are looking at this barbell approach of defensives plus some risk.
John and Danny earlier in the program are talking about how good news feels like good news and bad news feels like bad news. But you said earlier, if we get a good employment report, would that mean bad news for this market? Potentially, some people will say maybe that irks the Fed a little bit.
No, I don't think so, because that brings us to the second part of the mandate, which of course is inflation, and we're looking for the CPI number next week to come in at 3.2% on the core CPI inflation. So as long as that inflation trend is intact, which is still gradual progress towards 2%, if we get a somewhat stronger labor market, I don't think that negates it. Look, the Fed really realizes right now that the real interest rates are high. They're tight. And so with the economy that's generally speaking slowing, they do have a lot of room to cut interest rates. So why not start a little bit? Is it 50 basis points for several consecutive meetings? I don't think we can make that call right now. But I think the start of the rate cutting cycle, regardless of jobs, is here.
We're certainly getting closer, that's for sure. Anastasia, thank you. It's good to see you as always. Thank you. Anastasia Amoroso of iCapital. Equity futures doing okay this morning. No real drama on the S&P 500 up by 0.2%. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Japan has issued its first ever mega quake alert after a 7.1 magnitude earthquake occurred off its southern coast. Several injuries have been reported in addition to limited damage to buildings. Right now, the country's bullet trains are running at reduced speeds, and some semiconductor factories have halted production. And Prime Minister Kishida called off a planned trip to Central Asia as a precaution following the warning. The government is not urging evacuations, but is advising citizens to be prepared that major earthquakes could continue. Several towns in western Russia have been evacuated after an attack by Ukrainian drones on a military airfield sparked a fire. State media reported that 9 people were injured and public transport was halted in one city, home to nearly 500,000 residents. It's part of what's become a nearly week-long advance into western Russia by the Ukrainian army, with troops reported 22 miles deep into Russian territory. And Donald Trump and Kamala Harris appear to settle on at least one presidential debate, with both candidates agreeing to meet on September 10th in a debate hosted by ABC. Trump said he had also agreed to debates on Fox News, and NBC. According to an anonymous campaign official Bloomberg spoke to, Harris will not agree to the Fox News debate and will only agree to future debates if Trump shows up to the ABC one. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, Fed Chair Donald Trump.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Can you imagine? That conversation up next from New York City. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, welcome to the program. A calmer take for you this morning. Equity futures up by just 0.2%. Euro dollar totally unchanged. Similar price action on dollar yen. If you're interested, we're going basically nowhere. 147 negative on that currency pair by about 0.1%. Bit of firmness, richness coming back into the bond market. Yields lower by 4 basis points. The 10-year about 394.74. Under surveillance this morning, Fed Chair Donald Trump.
The Federal Reserve is a very interesting thing, and it's sort of gotten it wrong a lot. He's tending to be a little bit late on things. I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
So here's the latest. Donald Trump using a Mar-a-Lago news conference to express frustration at the Federal Reserve. The comments echoing a Wall Street Journal report back in April, saying that Trump's allies are drawing up plans to blunt the Fed's independence should he win a second term. A report that Trump's team has since pushed back on repeatedly. Joining us now to discuss is Republican Congressman French Hill of Arkansas. Congressman, I'm going to start with a really dangerous question. What is the former president talking about?
Well, Jonathan, great to be with you. I think every president in the modern era has certainly criticized the Fed and lashed out at trying to have more control over the Fed. But since World War II, having Fed independence is important. We want to try to have price stability. That's their mission. I wish they focused only on price stability, but nonetheless, that's their mission. And over my time in public life, I've seen presidents try to influence the Fed through moral suasion by calling them over to the Oval Office, like Jim Baker and Ronald Reagan with Alan Greenspan for the 1984 election year. But the bottom line is the Fed can have its chairman appointed by the president. The Senate confirms that position. The House and Senate conduct major oversight over the operation. The Fed. So there is political tension there.
Congressman, we heard from Jared Bernstein, of course, from the White House, director of the chair of the White House Council of Economic Advisors. He tweeted this yesterday saying, history could not be clearer regarding the lasting and damaging inflationary consequences of ignoring this lesson of reversing the hard-earned progress of the past half-century. So you agree with the White House that the Fed should remain completely independent?
Well, I agree with the record of history that the Fed should be independent. That's a central bank tenet, that the Fed should generally, the central bank of a country should be independent of the fiscal authority or the legislative branch to protect price stability. And as I say, since World War II, when we had actually Treasury representation on the Fed board, that's been done informally through the appointment process to make sure the president's pleased with whoever the chair is. And the Senate confirmation process. And there have been times during tension where there's been White House meetings with Fed chairs or White House influence. Richard Nixon famously trying to influence Arthur Burns during the 1972 election cycle, the Jim Baker and Ronald Reagan anecdote that I just mentioned. But structurally, it's maintained its independence, and I think that's important.
So let's talk about some of the Fed policy. When the former president was talking about this yesterday, that he would potentially have a better gut feeling on what interest rates should be, he said that he, Chair Powell, tends to be a little bit late on things. He gets things a little bit too early and a little too late. And he says he would have this feeling that potentially he'd be a better Fed chair because of that. Do you agree with where the Fed is right now, or do you think they should be cutting? And if so, do you think it'll be political for them to take this cut in September?
Well, Chairman Powell says they're data dependent. I think that's good. But I think the way to avoid these kinds of fights without much assurance of what direction or the other is to have a rules-based monetary policy. The so-called John Taylor rule from Stanford University. John and I worked together on the White House staff in the 90s. The so-called Taylor rule would make a range of mathematical recommendations on the targeting of short rates by the Fed, as opposed to it being just a group of individuals on the Board of Governors deciding that, or as Jim Grant refers to it, the PhD standard. We would actually have a rules-based standard. Some others want to go back to a gold standard, but a rules-based standard would have a range of guidance to the Fed of when to cut and how much to cut, and that would take some of this instinct out of it.
So, Congressman, given that, and this is a criticism other people have said, that the Fed needs more of a framework. They don't have a reliable framework at this moment. Do you think that's something that should be mandated in for the Fed? Would you like to see something along those lines?
I would like to see a rules-based framework. And when Chairman Powell was before the committee a few weeks ago, I asked him the status of their reassessment of their very famous decision in August of 2020 in the middle of a pandemic to just let inflation run a little hotter than 2%, knowing that they could rein it in, which I think is a strong presumption that I don't know that's based in fact, as we've witnessed since 2021. So I think that is an opportunity for the Fed to reassess using a rules-based framework for their monetary policy.
Congressman, since we last spoke, this race has changed a lot, particularly in the last month. Can you talk to me about how you see things evolving right now? When it comes to the issues, I think the impression that a lot of people have that are coming on this program right now is that we're not really talking about those so much. It feels like we're talking about the enthusiasm, the vibes, and the improvement that we're seeing on the Democratic ticket since the sitting president dropped out of the race. When it comes to the issues, I know that you're very, very focused still, Congressman, on immigration. Can you walk us through the things that you're concerned about? And do you think the former president is doing a decent job of prosecuting the case?
Well, first, let's start there. I think to win this election, it's a great opportunity for President Trump to be reelected. I think his policies are much more in alignment of my views are on the economy and national security, and particularly border security. But we've got to stay focused on the issues and get off some of the personalities here. Let's focus on the issues, and I think if President Trump and his vice president nominee, J.D. Vance, focus on the issues of national security, the border, community policing, inflation, they win, and they win hands down. On the border, what I'm the most concerned about by the horrible Biden policy of an open border is not just the millions of people he's allowed in the country that we don't have a full instinct of what to do about or how to handle it, and swamping our border patrol system, but the number of terrorists, people on the terror watch lists that are in this country. And we've asked Chairman Turner of the Intelligence Committee, Chairman Green of the Homeland Security, and I have persistently for months asked for this administration and the FBI and Homeland Security to tell us where these people encountered on the terror watch list are in this country. What has happened to them? And when you think about millions of gotaways, how many more people are in the country that we don't know about, that we did not encounter? I find this very concerning in light of the Pakistani comments about the Trump assassination attempt, the continuing documented Iranian influence in the country on assassinations, and the recent Philadelphia discovery of a ISIS-K network that was operating in the country, having come across our open border.
Congressman, if you're so concerned about the border, why did the Republicans then ditch this idea of the legislation that was circulating, starting in the Senate with Lankford, when it came to border security?
Well, first, we passed H.R. 2, which is the preferred approach for House Republicans on both immigration reform and border security. We got it passed. We sent it to the Senate. There was no action on it. Senator Lankford did good work trying to find consensus in the Senate. But look, he was still facilitating thousands of people, undocumented people, coming in the border. He was not taking the concrete steps that we put in H.R. 2. So I think, Anne-Marie, that was the key difference for Speaker Johnson, for House Republicans, and that's why that bill did not proceed in the Senate.
Congressman, we have to do this more often, sir. It's good to catch up, and
Great
I promise.
to be with you.
I say this every single year. Razorbacks football, we're going to make it happen this winter, okay? Going to make it happen.
You
all
got
right?
some.
Thank you, sir. Congressman French Hill
James.
of Arkansas on the latest in this race. The thoughts on the Federal Reserve there? I think we need to pick up on that. Could we see some real changes here?
Well, I think when you hear French Hill talking about this, he basically says, historically, we do know that the Fed has to remain independent. So basically, he agrees with the White House there, but he thinks the Fed should be more focused on inflation right now.
Yeah, and talking about this idea that there needs to be more of like a rules-based framework for them, I think a lot of people would agree. A lot of people have looked what Powell has done, and you hear this criticism come up. He's not an economist. He's a lawyer. He doesn't have a clear direction in where he wants to go. I think it'd be interesting if they mandated something like that, because I think a lot of people like the flexibility of the Fed. So having a clear framework versus mandating, I mean, that is two very different conversations.
It's hard to predict things at the moment, but I will predict this. Chairman Powell won't address any of this in Jackson Hole in that press conference, or rather that address that we get from him in a couple of weeks' time. That's my prediction. That's the only prediction that I can offer at the moment, given how quickly things have changed. Equity markets right now in the S&P 500 shaping up as follows. We're just about positive by 0.1%. Up next on the program, we'll dig deeper into the booming obesity drug market. We'll catch up with Deborah Netschert of Jennison Associates on why the growth is only getting started. That conversation just around the corner. From New York, this is Bloomberg.
It's a multi-trillion-dollar industry.